to relieve high gasoline prices, they're going to find themselves in a really bad situation when, say, there's a big hurricane that knocks out production in the Gulf and they haven't got the SPR that they need to alleviate true shortages. So it's really a delicate balancing act here. And there are other reasons why gasoline prices get very high. It has to do with refining. We've cut back on, we don't refine nearly as much as we used to. A lot of our refining has been switched over to biofuels, which are not nearly as useful or necessary as gasoline. So there are other things that they could do to help alleviate a gasoline crunch or gasoline price crunch that don't involve using the SPR.
Alan, thank you for that final word. Alan Wald there of the Atlantic Council. The SPR, the political battle of 2024.
Yeah, although we were talking to the person at Gas Buddy, and he basically was saying it's not going to be needed because prices are going down. But yeah, we're going to see. I mean, the fact that they're even sending these letters out.
I know. Well, they know where this is going if crude prices spike. They know exactly where this is going.
Right, so they want to sort of lay the groundwork of, you know, ire.
$4 a gallon on gasoline is going to really start to unnerve some members of the White House. And imagine it hits $5. This is the summer before an election. They're going to have to pull a lever.
The WTI down on the month by about 5%, biggest monthly drop of the year so far. So for the White House, at least, that might be what they want to see. For OPEC Plus, I'm not so sure. We're in this sweet spot right now, apparently, according to Alan Wald.
Yeah, that basically they'll try to keep things status quo. I think that's the message, frankly, for why they're just holding it remote. It's basically, we don't want to make waves. Just let's like zoom in and be lazy.
WTI about 77.89. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bill Ackman is planning an IPO of his investment firm Pershing Square as soon as next year, according to the Journal. People familiar say that as a precursor to the listing, Ackman will sell a stake to investors in the coming days with a valuation of about $10.5 billion. It's a chunky figure for the fund. For context, Brookfield has just a slightly higher valuation, but manages $925 billion versus Pershing Square's $16 billion. IPOs have also been challenged this year, save for the tech blockbusters. Paramount Global shares up in the pre-market trade 1%. That follows a report that Skydance Media submitted a sweetened offer for a merger with the company. Paramount's independent committee is set to review the offer shortly, that according to the Wall Street Journal. In recent months, Sony, Apollo, Warner Brothers Discovery, and media executive Brian Allen have all expressed interest in Paramount. The NBA Finals matchup is set. The Dallas Mavericks are the champions of the Western Conference after beating the Minnesota Timberwolves last night. The Mavs took the series in 5 games with a statement performance from their star duo, Luka Doncic and Kyrie Irving. They'll be facing the Boston Celtics, who are coming off of their sweep of the Indiana Pacers. That series kicks off next Thursday in Boston. That's your brief, John.
Hey, Danny, thank you. We'll catch up with you in about 30 minutes' time. Up next on the programme, Diverging Paths.
As a general perspective of the broad European economy, it's going to need more rate cuts than the US. So as you look at it from that perspective, that rate path does add to the attractiveness.
The ECB decision, a week away. The week after that, the Federal Reserve. All of that coming up next from New York. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
Equities on the S&P 500 pulling back negative here by 1/3%. Yields a little bit higher by a single basis point, 456. Under surveillance this morning, diverging paths.
As a general perspective of the broad European economy, it's going to need more rate cuts than the US. So as you look at it from that perspective, that rate path does add to the attractiveness. Now, I don't know how long it's going to be sustained. Are we looking at this as a long period of outperformance where US exceptionalism is dead? I won't go that far, but I do think that this is a tactical opportunity at this point in time.
So here's the latest. Eurozone inflation picking up this morning, more than anticipated, ahead of next week's ECB decision. The central bank widely expected to cut rates on Thursday, months ahead of a possible move by the Federal Reserve. Sri Kochagovardhan of Aberdeen writing this. The ECB won't be deterred from cutting, but there could then be a pause, and they may wait until the fourth quarter or even later to cut again. As for the Fed, we expect rate cuts to begin in September. Sri's with us right now. Sri, we've talked a lot about central bank divergence, the ECB going, the Federal Reserve going nowhere. From what I see in your research, you think there are limits to that divergence. Could you walk us through it?
Well, I think there is a bit of a sequencing in terms of timing, in terms of when they actually start the easing cycle. So obviously from the ECB, we've had some inflation data out this morning, but that's not necessarily going to change the timing for the start. Christine Lagarde has already committed to June, but then we could see some staggered beginning for other central banks. So, for example, Bank of England, there is already market pricing has pushed out the timing towards later on this year. So that June easing, the very first cut, that's unlikely to happen now. So really, it's a staggered easing cycle. But then we do have this common theme in terms of very sticky services inflation, core inflation. That underlying trend is proving to be a little bit stubborn across the different countries. So that really poses a question, how much can they ease after that? So that's really the debate amongst a lot of investors at the moment. It's, yes, they'll start cutting, but then will there be a pause? For the ECB, as a case in point, will there be a pause after that? How quickly can they start easing from here?
Let's sit on the ECB and the Governing Council. ECB President Christine Lagarde has done a pretty decent job of keeping a consensus together on the committee. Sri, do you think that typical north-south divide is going to reappear on the Governing Council as we start to have that fight beyond June and deeper into summer about what to do next?
I'm not really sure there's going to be a big division within the ECB itself. I think really what they're signaling is data dependence. There are some more hawkish voices within the ECB. However, there is still that consensus with regards to kicking off that easing cycle. They don't necessarily need to be as restrictive as they are. But then it'll be the timing. Perhaps we could see the next rate cut later on in Q4 from the ECB and a quicker pace as we move into 2025. Really, it's about that disinflationary path, which is already well underway, but there are some bumps in that final part, the final mile that everyone is talking about. Really, that's where the focus is going to be. So it does seem more data dependent. If we move to the Fed, however, there's a little bit more of a division already within the Fed, and we do see some members who are talking potentially about delaying rate easing, not just delaying, but actually moving into, some talking about rate hikes even. So we actually think that the most likely scenario for the Fed is that they start easing in Q4, most likely September. But again, this is very much dependent on what we see later today in terms of the core PCE outlook and the trend thereafter. Again, very much the key problem, the common theme is that stickiness in service wages and services inflation.
Sri, to John's point, though, there is this question about just in general the different regions of Europe and how they're benefited or not necessarily when it comes to particularly euro that could be weakening. I can think that Southern Europe, for example, during vacation season might welcome a weaker euro while you get Germany kind of pushing back a little bit more with some of the goods that they export for manufacturing becoming more expensive. How much does that sort of color the debate on the ECB in a way that is different than for the Federal Reserve?
I think it's true. The ECB is obviously trying to manage a number of fairly diverse economies there. But even when we look within that, I think Germany obviously has been quite key in this morning's number, in driving this morning's number. There has been some technicalities there that have led to, the cheap transport tickets. That base effect has led to a bit of a stronger number there from Germany, and that's had an impact on the aggregate inflation number. However, these technicalities are likely to unwind. Going forward, obviously, there are slightly different focus, as you mentioned. Those economies are responding to the trends in the euro in a different way. But nonetheless, the ultimate mandate for the ECB is to look at those aggregate numbers and to see where the inflation trends overall are going and looking at that, the overall good for the euro area economy. It's very difficult to try and nuance it according to Germany versus southern economies as well.
Just real quick here, Sri, is the inflation in Europe similar and more similar to the inflation in the US than many people thought?
I think in the US, obviously, the economy has been a lot more resilient there. And that's been a key difference, I would say. Euro area is recovering out of some weakness, some recessionary vibes that we saw in the end of last year. So there's a bit of a recovery there. But US has been remarkably resilient, despite the fact that we've had such aggressive rate hikes. And so this is a key difference, I think, in the two economies in terms of the underlying drivers of wage growth. There are some similarities, obviously, as you mentioned, with service sector inflation. But it does seem that in the US, it's correct that they would wait before they start easing. And it's also correct that ECB doesn't have to wait for the Fed. There was a debate earlier on, do they have to wait? Does everyone have to wait for the Fed before they start easing? That's definitely not the case. And we're seeing that very clear in the message where each central bank is very much focused on domestic drivers now. The pandemic-related global drivers, they've unwound. And here now it's really looking at the timing. The sequencing of timing is different because of the relative strength of each economy. So US, I'd say the big difference there is the resilience in consumer spending. And that's starting to slow. And that's another feature that we're going to be monitoring over the course of the coming months.
Hey, Sri, we've got to leave it there. It's good to catch up. Thank you. Sri Kochagovindan there of Aberdeen. On the next hour, in Bloomberg Surveillance, PIMCO's Libby Cantrell, Sam Stovall, CFRA, Delta Airlines CEO, Ed Bastian, Bob Michael of JP Morgan from New York. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
It's not unreasonable to worry about inflation.
We are seeing inflation come down. I think that when we look at the next couple of quarters, we'll probably see some ebb and flow.
We're kind of optimistic about inflation in the near term.
To get to that July cut, you would need probably some combination of soft enough labor market data and enough decline in the run rate for inflation.
The Fed's not going to be cutting rates because inflation is magically back down to target. They're going to be cutting rates because all of a sudden they have to start worrying about the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from inflation data in America. That's all Bramo wants to talk about. No politics, all economics and Fed speak. You take the Fed speak.
You're welcome.
Take the Fed speak over U.S. politics right now.
Well, what more are people going to say? They're the people who are entrenched in saying that this is a rigged trial, which is what Trump is saying. And then there are people saying, look, this shows that justice works and that a jury of 12 peers were able to convict him. And you're not going to get any cross dialogue between the two. So there's your in-sum from me.
These are the dates for your diary, the dates that Lisa won't be at work. Here's the first one. June 27th, big debate taking place next month. July 11th, Trump sentencing. And then July 15th, the RNC.
The RNC, where they're going to basically say this is our candidate and he is a convicted felon as of yesterday. 34 counts he was found guilty on. Though Lisa is less excited about all this, it is unprecedented times. What really matters to the market is, does this shift the narrative for the electorate? And I think in the polling we've talked about throughout this show is the electorate looks fickle on whether or not this actually matters to if they're going to cast a vote for Trump or Biden. What is key, though, both of these individuals, Biden and Trump, came out yesterday fundraising on this, saying it's November 5th that matters for the verdict for the American people.
Just to be clear, it's not that I don't find it interesting. It's just that right now, there are the people who are tuned in and kind of going with what they already believe, and then there are people who feel further tuned out just because it feels like this doesn't ever matter the way that people think it's going to matter one way or another. So it becomes exhausting, and it leads to this feeling disenfranchised by so many people who are not hardened on either side of the political aisle.
If you were going to vote for Trump before yesterday, you're probably still voting for Trump. If you were going to vote for Biden before yesterday, probably still voting for Biden. What the independents do, and this poll from NPR and PBS that we've been referencing through this morning, Anne-Marie, 2 in 3 registered U.S. voters say a guilty verdict would have no effect on whom they plan to vote for in the presidential election. What they decide to do could be very important.
That's right. That poll, 67% of voters say conviction would make no difference in November, including 74% of independents. That's the key part of this poll. But again, to my fickle electorate, Marquette Law School polling, they talked about the fact that a guilty verdict would produce a 4-point Biden lead in national head-to-head matchup with Trump, while a not guilty verdict would have resulted in a 6-point Trump lead. This is why the debate is going to be interesting. Who moves the needle after the debate?
That debate, a month away. Equity futures right now, if you are just joining us, welcome to the program. Plenty of market coverage, I promise you. Equity futures down 1/3 on the S&P. Lisa excited for PCE.
Oh, yeah.
A little bit later this morning. Yields up a single basis point, Bramo. The 10-year, 455.60.
Well, just think about the second read of GDP that came out yesterday, the fact that there was a bit softer consumer spending and that there was a bit softer kind of core inflation read. Move the market. Just think if we get a surprise one way or another. That's true excitement, and that's what we could get in about 90 minutes' time. The whisper number is actually for the lowest read going back till December.
There we go. We can see what Bramo's excited about. Coming up this hour, PIMCO's Libby Cantrell, as Donald Trump is convicted on 34 criminal counts. Delta CEO Ed Bastian sitting down with Guy Johnson on the airline's outlook for the summer. And Bob Michael of JP Morgan Asset Management still looking for a September rate cut. We begin with our top story, a groundbreaking moment in U.S. history.
This was a rigged, disgraceful trial. The real verdict is going to be November 5th by the people.
Here's the latest. A 12-person jury finding former President Donald Trump guilty of 34 counts of falsifying business records to conceal a hush money payment to an adult film star, with sentencing set for July 11th, just 4 days before the GOP convention. Bloomberg's David Gura is outside Trump Tower here in New York City. David, good to catch up with you, buddy, as always. What's next for the former president?
Well, we're going to hear from him later today. He's going to hold a press conference at 11 o'clock in New York, and that's when he's going to try to move this from that legal arena into the political one more fully. And picking up on what Lisa was saying, respecting what she's saying about this being kind of an intellectual exercise and people's views on this being so calcified, I think we're at this moment where it's yet to be determined how much this resonates with the U.S. electorate. And what we're going to hear from the former president today is an effort to kind of situate this in politics, in the campaign, yes, to cast aspersions and doubt on the proceedings that just ended yesterday, but also to look ahead squarely to the general election on November the 5th. Now, of course, July 11th looms large. That is the sentencing date. And so here we are in this kind of strange vacuum where there'll be filings in that matter, sort of what each side thinks the sentence should be, if there should be a sentence at all, I assume on the part of the defense. And then the appeals process will be underway as well. And all the while, this effort to raise money off of what happened yesterday on both sides, to sort of do a very delicate ballet around what's happened here. You saw a tweet from President Biden yesterday, also looking ahead to the election in November, this awareness that, yes, this is a significant moment, an historic moment, an unprecedented moment, but what does that really mean? How is the country going to react to this? And that election date, that general election date, being the sort of moment when this truly will be sorted out. And I will just add as an addendum here, and I think it bears mentioning over and over again, what transpired yesterday, that guilty verdict, being guilty of those 34 felonies, does nothing to neuter the president's ability to run for re-election in November.
David, what's been the reaction from Wall Street? Any indication you've seen that they're shying away from potentially pouring money into Trump?
No, I think quite the contrary, actually, Emery. So you look at a story that Bloomberg has out this morning, kind of taking stock of the way that Wall Street is headed here. You know, a few days ago, we had Steve Schwarzman of Blackstone throwing his support fully behind the president after he cast doubt on the virility and viability of that campaign. We're seeing reports now that Bill Ackman, the hedge fund manager, is close to endorsing Donald Trump as well. So if anything, I think we're seeing among top financiers a willingness to embrace this candidate in a way that they hadn't before. And I think that bears watching as all of this goes forward. I think they, from the commentary that I've read thus far, what we've heard from those people, sort of see this as an aberration, as something that's a distraction from the policy matters at hand and sort of the general election more broadly. So they seem to be at the vanguard here of, again, casting doubt or throwing shade on what happened here yesterday and looking ahead to the election in November.
David, looking forward to your coverage throughout today on Bloomberg TV and radio. Bloomberg's David Gura with us around the table here in New York, PIMCO's Libby Cantrell. Libby, good morning to you.
Good morning.
What changed yesterday? What are you telling clients?
Yeah, so I think actually your analysis before David Gura's segment was exactly right? This is going to embolden the base of each party. What we saw yesterday was that Republicans on Capitol Hill had one of their most successful fundraising days in history. So this will be great from a fundraising perspective. It will be great in terms of emboldening the base. But really where it matters, John, and I think it's way too early to tell, is how does this influence that independent voter that you were all referring to, that suburban voter. This election likely will be very close. This election will likely be determined at the margins. So any sort of marginal issue that may move that marginal voter actually matters. But it's again, too early to tell. 5 months before the election, what we have been telling our clients sort of incessantly is it is too early. It is too early to have a high conviction, particularly at the top of the ticket, either way. And I think what happened yesterday just simply underscores that.
What does each camp need to say to the independents to make sure that when November 5th comes, they cast a vote for their party?
Yeah, so I think that's a really important point, because it's not only this event that happened yesterday, but it's how each candidate actually responds to the event. So does President Biden, for instance, use this as an example to sort of pivot to issues that Americans really care about? As you said, a lot of Americans are disillusioned, they're discouraged, they're befuddled by the choice in front of them. They don't want to talk about this. They want to talk about the future. So can Biden sort of compartmentalize this and then move to the future? And then for President Trump, can he also, I mean, he's going to use this for fundraising, and that will be, successful for him. But can he also then appeal to that middle of the country in terms of his vision going forward? Because elections are about the future; they're not about the past. And if he is just relitigating the past, again, that could hurt him with this marginal voter.
But for the Biden campaign, they need to be careful, right? This is a fine line they need to walk. Do they just come out and say Trump is a felon? Or can they actually go further without looking like they're benefiting from what Trump is calling this a politicized case?
Yeah, so I mean, I think it is a delicate balance. But President Biden needs to make this a choice between the two candidates, not just a referendum on him. However, what you saw yesterday, I think is probably going to be indicative of the Biden campaign response, which is just saying, justice has run its course, and we're focused on other issues.
I do wonder if there's a broader takeaway. You talk about how people are feeling disillusioned, disenfranchised, this sort of frustration. We're seeing that in a lot of youth polls, in particular, as people are sort of befuddled as to why we have this combo. Is there any larger implication, though, for the political system and what's going to transpire after this election as a result not only of this prosecution, but also just in general how this is playing out?
Yeah, well, I think, we're really focused in between now and the election, but in terms of
think behind it. Can you tell?
I'm very quick to pivot to 2028. Let's talk about the 2028 presidential cycle. Okay. Let's talk about that, guys.
All right.
No, but I do think this is right? I mean, this is, and we sort of joke, this is the election that very few people want. If you look at polling, between 50 to 70% of Americans don't want either candidate to be the next president of the United States. And I do think that it has maybe some practical implications running up to the election. I mean, what is voter turnout? There is a real risk that this is a low turnout election. Now, I think the question for political analysts is who does that help? Because historically, low turnout has actually helped Republicans and high turnout has helped Democrats. Because of the realignment of the parties, that actually, the dynamic could switch.
We are starting to think about the inflationary outcome of this election. To be fair, there is a policy conversation going on.
Thank you.
I know maybe not yesterday afternoon, but it is happening. What are you saying at the moment about who is going to be the bearish candidate? And I know that's super, super difficult to draw a conclusion on.
Super difficult, Jeff.
But I'm starting to hear from people like Matt Lazzetti at Deutsche Bank, who is saying this Federal Reserve might have to stay on hold for the whole of 25 if we get the kind of tariffs that the former president is talking about. Where are we on all that stuff at the moment?
Yeah, and honestly, this is exactly what our clients want to focus on. They don't want to focus on the horse race. They do want to focus on, Lisa, to your delight. They want to focus on the policy implications. I mean, I do think really it will be likely a mixed picture, but under a Trump administration. But it's going to be so dependent on, as we've talked about, the composition of Congress. Also, what does he do exactly what he says he's going to do? Now, on tariffs, on immigration, that is where we think that there could be an inflationary impulse. Of course, tariffs are likely going to be inflationary. That's what we saw with the original Trump tariffs on China. They were basically completely passed through to the consumer. Now, the question is, does he really put 60% tariffs on China? Because, and Anne-Marie and I have talked about this, that this not only has an inflationary impulse, but also has actually, maybe even more so, an impact on growth. So for the Fed, that is, that could be a conundrum. Again, should he put the 60% tariffs on China inflationary, but if anything, you could actually have a more severe impact for growth. So I think, John, the bottom line here is there's a lot that's unknown and difficult to sort of prognosticate the Fed's behavior going into 2025 when, again, there are so many unknowns.
When it comes to something like tariffs, Trump could do that unilaterally pretty quickly, but the composition of Congress matters for basically everything else. What's your base case for the House and the Senate?
Yeah, so I think that tariffs and then also on immigration, there are things that he can do on both on terms of the flow of immigrants and then also importantly on the stock of immigrants. And we know that immigrants have actually had a pretty profound impact on the economic circumstances of the country over the last year or so.
Thank you.
But exactly, John. Sorry, we should point that out on every segment that we're talking about politics.
Thank you.
Immigration is so important.
Single-handedly boosted the GDP.
Yes, but anyway, but in terms of fiscal policy, most importantly, that is what resides with Congress. And does what happened yesterday impact these down ballot races? Maybe. What we do know, of course, is that the Senate is incredibly vulnerable for the Democrats, which hold the Senate only by one vote. So pretty high odds that we could see the Senate flip. The House, I think, is really an open question at this point. And this is where actually, because the House is much more of a national election, the Senate, only 34 of the 100 Senate seats are up for re-election. So I think that these types of things that happened yesterday can actually influence the direction of the House. But again, too early to say.
Too early, but we're talking about it.
We're talking about it.
Libby Cantrell of PIMCO. Talking about it because Brammer might go nuts if we don't. No, we carry on talking about the events of yesterday.
That's so sweet of you. I haven't already gone nuts.
Done this just
That's
for
kind.
you. 1 hour, 15 minutes away from PCE data in America. Equity futures down by about 0.2%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Dallas Fed President Lori Logan says that policy might not be as restrictive as believed. Because of that, she said, quote, "It's important to keep all options on the table." That, though, contrasts with New York Fed President John Williams, who said he sees ample evidence that policy is restrictive, and doesn't believe that the neutral rate has risen. It is a rare but perhaps growing divergence among Fed officials. Tesla shareholders are being urged by a proxy advisor to reject CEO Elon Musk's $56 billion pay package. ISS says the compensation plan was, quote, outsized from the start. Back in January, a judge in Delaware struck down Musk's pay package, saying the company's board wasn't fully transparent with shareholders when they made that deal. And New Yorkers will get a taste of international cricket over the next few weeks. A 34,000-seat temporary stadium has been constructed on Long Island. It will host 9 matches of the upcoming T20 World Cup. Tickets for the showpiece match between India and Pakistan sold out immediately. Tickets on the secondary market start at around $1,300. That's your Bloomberg Brief, John.
If anyone wants tickets, Anne-Marie has some. Very keen on cricket after her time in England and looking forward to the big event, aren't you?
Oh, yes, John.
Good.
Remember, what did I call it? Cricket reminds me of Quidditch.
Quidditch, yeah. I've forgotten about that.
Yes, she wanted to repeat
Truly
that.
insulting. Coming up next on the programme, I don't really care. The calm beneath the surface.
For the majority of companies, they're seeing relatively moderate growth. We think equities are going to be pretty much sideways for the next few months.
I can't pretend I care. How dare you? Is that my posh voice? Did that work?
I know you don't want to go to cricket.
dare
You
you.
want World Cup.
I'd love that.
I'm
Gotta
working
make
on
that
it.
happen. Make that happen. That conversation, not that one, but the one we were talking about before is up next. From New York, this is Bloomberg. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities just a little bit softer this Friday morning. Good morning to you. We're down by 0.2% on the S&P 500. Under surveillance this morning, the calm beneath the surface.
The rest of the market is not seeing anything like the kind of growth of that small number of large companies. And while the index has gone up because the weight of these super large tech stocks, for the majority of companies, they're seeing relatively moderate growth. We think equities are going to be pretty much sideways for the next few months.
So here's the latest. Futures edging lower ahead of key inflation data 8:30 Eastern Time. The S&P 500 poised for another month of gains. For the month of May, we are down on the week through Thursday, though. Sam Stoffel of CFRA writing this. It's been rumoured that between Memorial Day and Labour Day, investors focus more on their TANs than their portfolios. The S&P 500 gained an average of only 1.6% in price between these two holidays since 1945. Instead of experiencing the summertime blues, it frequently enjoys a summertime snooze. Sam joins us now for more, and hopefully, Sam, you'll wake us up a little bit more than that. Sam, what are you advocating for then for clients through the rest of this summer? To sit back, chill, and ignore everything?
Well, good morning, Jonathan. I think certainly there's a lot of reasons why one might say that this Memorial Day through Labor Day period might be quite different from other election years since World War II. Certainly now we know that AI has been driving tech and semiconductors, but EI has really been driving the rest of the market, EI being earnings and inflation. And now with the worry once again that the Fed could be raising interest rates, possibly staying higher for longer, causing a recession. I think that's what's, in a sense, causing cracks to form underneath the confidence of investors today.
So does that mean that, Sam, you think that people shouldn't go try to tan and they should actually be in the office actually trading because otherwise they could lose their shirt?
Very good, Lisa. I like that one. No, I think that what we typically find is that many of the groups, while they do tend to tread water, investors do tend to gravitate toward the more defensive areas of the market. I always say that you are much better off rotating than you are retreating in this traditionally staid period of the year. And it's usually those areas like staples, healthcare, utilities, et cetera, that have done well. But I guess this time around, what we're seeing is that since the Dow hit 40,000, really there's been no place to hide. The market really has been selling off quite a bit, with technology being the only group that's still in positive territory.
And it seems like any kind of miss or even in line that isn't necessarily off the charts for some of the biggest winners this year have been punished severely in terms of market reaction. I wonder if there's a larger takeaway, though, and we were exploring this yesterday with Peter Oppenheimer of Goldman Sachs, that at this point, at this level, based on how much yields have moved up, that is going to be the tail wagging the dog when it comes to the equity markets. That the further the yields go up, the more punitive it becomes for the stock market. Do you believe that?
Oh, yes, because I think that's the real factor that is causing concern. I mean, our expectations had been that we would see a gradual decline in the 10-year yield as the year progresses. And so obviously with it going in the opposite direction, that makes us sort of second guess our own opinions. And I think the same is being done by other investors. So our belief still is that the Fed will be cutting twice this year, September and December, obviously knowing that now September is more like a coin toss as to whether that will happen. We also remind investors that every election year since 1992, except 2012, had the Fed either raise or lower rates prior to the election, many times occurring in September. So I think the Fed would love the opportunity to show that they are apolitical should the data allow for that.
Sam, if September's a coin toss, what does the Fed need to see in the data before September to have that confidence to cut just before an election?
Well, I think they're going to have to see today's PCE, and successive PCE indicators show continued downward trend. I think we're likely to see the unemployment rate maybe tick up a couple of basis points, and also just see that maybe the second quarter GDP does not come in as the Atlanta Fed is anticipating at this point, well above the 3% level. So I think the Fed is basically going to be sticking to its mandate by saying, can we see inflation come down while not having a material impact on employment?
Sam, I just want to take the conversation, finish this conversation somewhere where Lisa's been leaning, and I think it's an important conversation. What's happened with Salesforce in the last 24 hours? Down by about 20%. What happened with, say, Dow? Dow down by about 15% in pre-market. The Dow numbers, to Lisa's point earlier this morning, they weren't terrible. In fact, they were a beat. It just wasn't a big enough beat, and you're seeing a monster move in quite a sizable company, Sam. And I'm wondering from you and the team at CFRA, the kind of signal that you're taking away from this kind of price action.
Well, I think, as Lisa was saying before, that companies are being punished if they don't meet the published numbers or even the whisper numbers. Technology for this first quarter is showing a 25% gain in earnings versus the earlier anticipated 20% rise. Also, we've seen an improvement in not only 2024, but also 25 estimates, now 20% for the sector in 2025. But it continues to bump up against the 30 PE for the sector itself on forward 12-month earnings, which has resulted in pretty much a locked ceiling, if you will. And so with these numbers really at stretched valuations, I think there is the need for the resetting of the dials, at least in the near term.
Certainly seeing that as some single names, that's for sure. Sam Stovall there of CFRA. We're talking about a 20% move on Salesforce, which is a big, big company. That market cap move, I think, was something like 52 billion in the period, which is, you know, some hefty chunk of change, which I know we've sort of gotten used to because we see these big moves in NVIDIA, but still, that's a sizable move.
Especially at a time when the reason why really is just simply that AI adoption isn't going to really monetize that quickly for them, that it's going to take until next year, the year after, for them to really reap the financial gains from this. If you take a step back, I wonder how much people are getting worried that artificial intelligence, the hopes of how quickly it's going to be sort of borne out in lots of different industries, if they're worried that maybe we've gotten over our skis a little bit with that narrative. Yep. And that's how I really read a lot of these moves.
With the exception of NVIDIA, which has just surged again through May. Saw a similar move on American Airlines, a move of 13.5% lower a couple of days ago off the back of their change to their outlook. We want the outlook from Delta. We'll get that next from the CEO, Ed Bastian, sitting down with a brilliant Guy Johnson. That conversation just around the corner. Equity futures right now in the S&P 500, negative by 0.25%. The main event, in the economy at least, for the Federal Reserve and for markets perhaps as well. The PCE data, 1 hour away. is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
60 minutes away from PCE data in America. Equity futures on the S&P 500 negative by 0.2%. Another read on inflation. Going into all the Fed speak. Going into the weekend, then you won't get any. I know that's good news. There's a lot that Lisa's excited about this morning. The inflation data in about an hour. Lack of Fed speak after the weekend. Feeling good, aren't you? Let's get you to that weekend. Futures look like this. We're down 0.2% on the S&P. We're negative 0.4% on the NASDAQ. The scores in the bond market are 2-year, 10-year, 30-year. Let's shape up as follows. 494, we got really close to 5%. We've seen 5% once this month. It was the first day of May. And Lisa, since then, we backed away. Then we got closer in the last couple of days, and we backed away again.
It's hard to know exactly how much credence to put into this because, as Peter Scheer was saying, it seems like there's a lack of liquidity, and as Sam Stovall was saying, there are people who are trying to go to the beach pretty aggressively. That said, there is this feeling that Lori Logan really crystallized, which is we don't really know how restrictive rates actually are. We can say they're sufficiently restrictive or you cannot. We don't know. And with that ambiguity as a framework, I think you could see some of these auctions really whip around the action, especially with a dearth of other actionable news.
I think it's a recipe for a really interesting conversation on the FOMC in 2 Wednesdays' time. I think it's going to be very interesting to see how that debate takes place, how the chairman tries to reflect the lack of consensus in the news conference, because we've seen some daylight between him and the minutes a few times.
At this point, how much does he address R-star, this idea of what the neutral rate is long-term? Some people call it a fiction. To me, it seems like Jackson Hole is going to be a real moment because they're going to have to come out and they're going to have to make some sort of proclamation about how they've engaged this or a strategic framework of how they filter in data points that seem to matter or not, depending on the day.
TK stopped me on the way out the door yesterday. Are we going to Jackson Hole? Shall I book my flight? I said, plans are coming together. We're trying to make that happen.
Are you booking that?
We're trying to make that happen.
You're arranging it in the background.
Yeah, let's see. End of August. Something else happening at the end of August too, right?
The DNC, that's where I'll be.
So there you go. There's a lot of events coming up this summer. And as events this morning, let's talk about the politics. A New York jury finding former President Donald Trump guilty on 34 counts of falsifying business records. Sentencing is set for July 11th, just 2 weeks after the first presidential debate. And Anne-Marie, 4 days before the RNC.
Where they're going to crown that 100% Trump is going to be the nominee going into the November 5th election. And this all comes down to how do the voters feel about the fact that Trump was guilty on 34 counts? That's what the markets care about because what the voters decide potentially will shape this election. Going into this verdict, the polling has been very murky. It's a fickle electorate, which is why how they campaign is going to be interesting. And the start of that is going to happen at 11 a.m. today. We'll hear from the former President Donald Trump.
Looking forward to those polls as they come in over the next few days and weeks. Let's turn to a big mover in the pre-market. Shares of Dow falling, and they're down hard. The company reporting its first revenue increase since 2022, but it wasn't enough to impress investors. Dow facing lofty expectations for its AI server business, with the stock soaring 122% so far this year before this move.
Okay, so on one hand, 122%, and then you drop 16%. It looks a little bit less significant in terms of the scope of the drop. But to me, the fact that they beat expectations, that they did talk about a 30% quarter-over-quarter increase in some of their new AI-equipped servers, to me, that wasn't enough highlights this question, which is really big, that looms over the entire market. How much have people kind of gotten over their skis with the non-NVIDIA rest of the world basically being able to adopt AI as quickly as people previously priced in? NVIDIA's winning. They're making bank. They're consolidating this. But it's NVIDIA's win. It's not necessarily everybody else's win. And I think that's what we keep learning.
Lots and hopes and dreams for this company. That company is down by about 15%. Just getting confirmation. We are going to Jackson Hole.
Okay.
Okay.
All right.
Well, I'm
TK's
not.
coming too. You're not, you're at the DNC?
Yeah.
Okay, good to know. That's the schedule for August. We don't need to know that now, do we? Okay, but we are going to go, all right?
Okay,
Tom's
thanks.
watching. All right, let's turn to this story. Boeing will remain under close scrutiny from aviation regulators after sharing a detailed plan to address quality breakdowns at its factories. The plan is based around 6 measures, including employee skill and the number of hours worked, spend addressing defects during final assembly. This story's going nowhere, isn't it?
That's exactly how I feel. What's there new about this? They haven't figured it out, so we're all left wondering when they're going to figure it out. And in the meantime, there's a question of whether there's going to be a backlog of planes and whether we end up with people saying, look, if you don't want your planes, I'll buy it at a discount. I mean, it's just sort of this disconnect between what the practical implications are for some of these airlines that are waiting for the deliveries and the reality on the ground, which is we still don't have answers as to what went wrong.
Let's get to some of those airlines right now. Some of them struggling this week after American slashed its outlook for the second quarter. The revision dragging down the broader industry heading into a busy summer. I'm pleased to say that Bloomberg's Guy Johnson is joined by Delta Airlines CEO Ed Bastian in Dubai. Guy Johnson, over to you.
John Farrow, thank you very much indeed. Yep, Ed Bastian here in Dubai. Tonight he's going to receive the ATW 2024 Airline of the Year award. That's why he's here. He's also here as well for the 80th IATA AGM, which is going to be taking place here at the start of next week. But John, you bring up a couple of stories, actually. You bring up what's happening with Boeing, but you also bring up the issue that we had earlier on in the week with the American numbers and the impact that that had on the rest of the sector. Ed, great to see you. Congratulations on the award, first of all.
Well, thank you, Guy. It's good to be with you. It's good to be in Dubai, and really proud of our team.
Yep.
Their ability to continue delivering outstanding results for our customers is what makes these awards, first of all, very humbling to receive, but hungry to continue to win them.
Yep, you got to keep it up, don't you?
You got to keep it up.
Let's talk a little bit about kind of what is happening in the market right now and those customers that you talk about. We did see the American downgrade in terms of its guidance a few days back. I'm not going to ask you to comment on what is happening over at American, but really just to kind of get a comment on whether you're comfortable with your current guidance.
Yeah, the demand has been really strong. I think that was the issue, that with the American numbers and the quarter, as we've indicated all along these last several years, that consumer demand and that priority to invest in experiences continues to be really, really healthy. June for us is always the largest travel month of the year, of the calendar. So we still have to see how June's going to go, but I'm confident it'll be a good result for the full quarter, and we'll see how June runs out.
Are you seeing any evidence that inflation, and it's inflation day, we're going to be watching those numbers, that inflation is starting maybe to hit the middle-class traveller, that the middle-class traveller is beginning to rethink maybe the attitude towards travel, which has been really strong over the last few years?
I don't see it. Our consumer tends to be at the upper end of the income scale. Our traveler tends to go internationally. Our consumer is prioritizing travel above things. So while you may be hearing from a number of industrial sectors, trade downs occurring, we're not seeing that in our numbers.
Do you think you will see that at some point? Do we go to a more normal? Is this the new normal in terms of what travel is going to look like? Will this continue to persist? The stock market continues to do very well. We're obviously seeing an upper-end consumer that is still fairly flush with cash. Is that something that lasts years?
I think it's going to continue for quite a few years to come. One of the factors people don't give enough consideration to is our industry's capacity is lower than it's been, given the constraints around OEMs, whether it's Boeing or engine issues. So our economy is a lot larger than we were historically, go back pre-pandemic, yet the amount of capacity that we're all able to fly is significantly constrained, and that's what's keeping demand as well as pricing pretty strong.
Okay, pricing. So fares are still fairly robust, aren't they?
Yeah, fares on balance are about 20% higher than they were pre-pandemic.
You bring up business travel as well. Is that something that it has come back? It's maybe come back significantly more slowly than we've seen in terms of the retail story. But is that coming back? And ultimately, given that bigger economy, is that a bigger number somewhere down the road?
Well, business travel this year, particularly in 2024, has really stepped up. As we went through the return from the pandemic in 22 and 23, business travelers were still a bit sluggish, largely because they weren't back in their offices, and they were still working from various remote locations. Once companies have finally laid the edict down, you needed to get back. And particularly as some of those businesses started to get a little challenged themselves, people wanted to be back in the office. That opened up the need to travel, for consultancies to go visit clients, for people to get back out on the road to see their own people. So we've seen we saw about a 10-point increase in business travel at the start of the year, and that's continuing to climb.
Middle of the P&L, top line, okay, so we talked about that, that's looking good. Middle, what's happening in the middle of the P&L? Are you still seeing, what kind of inflation are you seeing in the business?
We're seeing inflation, but it's starting to moderate a bit. For us, the biggest part of our inflation story is wages, is our people, which that's the best type of inflation we can have, and our people continue to grow. Wages in the 4 to 5% per annum rate. We're continuing to work on productivity and efficiency so we can take some of those rates and make certain that they're productive increases. Other parts of the supply chain, where the supply chain's still not where it needs to be. We talked about the engine issues. We still don't.
How much is that holding you back?
Well, it's significantly. Again, it's not just Delta, it's the industry. And the turn times are longer. You now have turn times on planes that could extend up to months rather than weeks, which they should be. Parts are higher than ever. Material costs are growing. The manufacturers across the industry are having challenges.
This doesn't sound like an economy that you're describing that needs rate cuts right now.
Well, it's an economy right now, from my standpoint, that's doing well. But there's not just one consumer out there, right? Our consumer, again, tends to be in the upper end. Our consumer generated a tremendous amount of wealth and continues to have that wealth through the pandemic. The market's up, real estate's up, unemployment is extraordinarily low.
They don't need more help, is basically what you're saying.
The lower end, I think there's some challenges. So that's something that the Fed will look at all the data. I don't think an airline is necessarily the indicator.
You've got a pretty good view of what's happening in the economy.
Yeah, our business is doing quite well.
Okay, you bring up Boeing. You talk about what's happening with the OEMs, Boeing and Airbus, but it's also the engines, as you mentioned, the Pratt & Whitney engine issues that we've been seeing. How long does this last? How much of a struggle is it to get hold of the kit that you need right now? How long do you think the problems that we're seeing at Boeing and Airbus and Pratt & Whitney are going to be lasting for?
Well, right now we have no Boeing orders that we're anticipating delivery on in the next several years. So from our standpoint, it's really an Airbus story. Airbus has been a great partner, and Airbus continues to provide us the planes and the technology that we've been expecting for them, and they were right through the pandemic. The engines are going to be a bigger issue, particularly for us, the geared turbofan. That's slowing down a little bit about the amount of new deliveries that we can take, but it's more engines than it is planes. And what it's causing us to do is maintain the existing fleet we have a little bit longer, so that's another cost to the business.
You are well known for keeping your fleet for longer. It had the age of the average aircraft has come down a little bit over the last few years. But does that strategy work in an environment where the sustainability question comes in? If you fly older planes, they inherently tend to be less efficient. Is that a problem that you're going to come across at some point?
I don't think so. Again, I think this is transitory. I think the OEMs will get their parts. I think they will get the transition. Again, a lot of this is about labor and the fact that many of the engine, not just the tier 1, but down into the tier 3 and tier 4 of the supply chain, let a lot of people go. So it's experience, it's staffing, it's rates. I mean, it's a very complex story. But long term, I feel good about our sustainability story. We're taking our overall footprint down in the range of 1 to 2% per year, every year, and that's going to continue to go on. And as we get new planes, those numbers are going to go down faster.
Politics is going to become a bigger and bigger issue over the next few weeks and months as we approach November. When you think about who goes next to the White House, what does the next administration need to do to keep the aviation market that you've just described, this buoyant market, this market with momentum, keep it going? What do you need to see from the next administration to keep it on track?
Most important thing is infrastructure investment. Maintaining the current structure is challenging, and they need to continue to modernize the technologies. They continue to need to get air traffic controllers staffed and hired and in position to enable us to grow. And from an investment standpoint, that's where we're very happy to see the FAA reauthorization bill finally come about. It took, unfortunately, months, if not a year overdue in its delivery, but it's here now, and we're going to work closely with the FAA to make that happen.
Just to wrap the conversation up, you feel like you are on the front foot at the moment. This is an airline that is growing. What is the capacity constraint that you are seeing right now that is going to slow your rate of growth down? If I'm an investor looking at Delta, is this as good as it gets? or does it get better from here?
We're doing well on capacity growth. This year, we expect to grow our top line in the mid-single digits, in that 4 to 6, 7% range, which I think is healthy growth, considering particularly the growth we've had over these last handful of years. This year will be the highest revenues in our company's history. Order of $60 billion plus or minus. And the outlook, I think, is strong because I think the supply chain and the constraints are only going to get a little bit better as we move forward.
Ed, congratulations on the award, the ATW award that you'll be getting here in Dubai this evening. Great to see you here in Dubai.
See you.
Thanks for stopping by to see us here.
Thanks, Guy.
Bloomberg.
Great to be with you.
Thank you very much. John, from Dubai, back to you.
Thank you, buddy. Great to catch up and hear that conversation. Guy Johnson there with the Delta Airlines CEO, Ed Bastian. That stock just turning positive in the pre-market. Two big takeaways. I'm paraphrasing here. We're not American Airlines. One. Two, we have a more affluent traveller, and we're not seeing trade down. We're not losing business. Two big takeaways in that conversation.
And frankly, this is actually why American Airlines was penalized. That Delta and United, but Delta more particularly, is doing a better job monetizing some of their clients and catering to higher end, particularly business class travelers that pack the lounges.
Yeah, this is how we started the week. Is it an American Airlines problem? Or an airline's problem, and we're finding out from the other airlines it's the former, it's not the latter. Equity futures right now on the S&P, negative by 0.2%. Up next on the program, diverging Fed speak.
Looking at this broader context, the behavior of the economy over the past year provides ample evidence that monetary policy is restrictive in a way that helps achieve our goals.
That conversation just around the corner. Bramo disappointed we didn't get questions about the lounge and what's happening at Terminal 4 and what they can do about it.
You spend too much time at airports.
Too much time in Terminal 4.
All right, we could discuss this later.
Futures negative. This is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bob Michael in the studio. First thing he says, what are you doing here? It's Friday. I didn't know that was a thing. You don't have to be here on Friday.
Please sign me up. Well, if you weren't here, who would say, let's get us to the weekend?
I would agree. It's a duty that I've got to come and fulfill. That's why I'm here. Let's get you to that weekend. Equity futures on the S&P, negative by 0.2%. Yields unchanged on a 10-year, 455.21. Under surveillance this morning, sufficiently restrictive.
Looking at this broader context, the behavior of the economy over the past year provides ample evidence that monetary policy is restrictive in a way that helps achieve our goals. We're seeing clear and consistent signs that the imbalances between supply and demand in the economy are receding, and we've seen a broad-based decline in inflation.
So the current New York Fed president thinks we are sufficiently restrictive. The former New York Fed president is asking whether we actually are or not. And he's got some company on the FOMC in the Dallas Fed president, Lori Logan. Bob Michael of JP Morgan Asset Management writing this: a soft landing continues to unfold and should allow the Fed to cut rates in September and December. Bob is with us around the table. Bob, good morning to you.
Good morning.
Are we sufficiently restrictive or not?
100%, absolutely, we are sufficiently restrictive.
So Williams over Dudley?
100%.
What tells you?
Well, this is the highest Fed funds rate since the 6.5% of 2000, when we were in the midst of the dot-com bubble. And even then, 6.5% was plenty strong enough to slow things down. So I think 5.25%, 5.5% is plenty strong. We're going to get core personal consumption expenditures in about 40 minutes or so. That should come in year over year around 2.7, 2.8. That's half of where it was a couple years ago. So things have slowed down a lot. You've got a very high real Fed funds rate. You look at the bottom half of businesses and households, they're slowing down. Don't listen to me, listen to Brian Moynihan, who was out yesterday saying, oh, goodness me, look at the slowdown that's occurring there.
How relevant do you think payrolls is next Friday? A week today, in about 40 minutes' time, we'll get that number. How relevant is that number?
I think the personal consumption expenditures number is very important, just so that we know the disinflationary trend is underway. We're not going to get that close to the 2% target, but we'll confirm that we're on that path. That's good enough. For the Fed to think about moving earlier, they're going to have to see more stress in the labor market. They're going to have to see unemployment start to go higher meaningfully. Think 4.2, 4.3%. We're a little bit away from that now, but that could change over the next few months.
Okay, you said yes, definitely sufficiently restrictive. So then why haven't we seen more of a slowdown as of yet? Why have we been surprised consistently by how hot inflation has come in and, frankly, how strong growth is?
Because there's a lot of money still sloshing around in the system from all the fiscal transfers that have occurred during the pandemic. And that just takes time to work its way through. But it is. And you are seeing the pressure on the bottom half of income earners. They're putting more on credit. They're cutting back purchases across the board. Maybe they're still trying to get in a bit more of spending on services, travel and leisure in particular. That probably starts to slow down over the summer. There is sticker shock in prices, and you are seeing the stress in businesses. When you look at small and middle market corporate America, that's where the amend and extend is occurring. That's where they are cutting back on CapEx.
Can two things be true at the same time? We all kind of agree that there has been a real weakness, particularly in the middle and lower income consumer. We see this with the small caps, that there definitely is stress there. But then we have people saying, even with that, if you cut rates now, you add to that money that's sloshing around. We saw M2, the amount of money in the system, actually increase for the first time in a couple years in the past quarter. If you cut rates now, you're going to turbocharge inflation next year, potentially, especially if there are certain kinds of fiscal policies put into place.
It depends how far and how quickly you cut rates. If you do what the Fed did in 1995, and I believe Fed Chair Powell is well aware of what they did, they just took the edge off of businesses and households. They had hiked rates from 3% to 6% in a year, and then they cut rates 25 basis points and then 50 basis points. That was enough to ensure a soft landing. I think that's what Fed Chair Powell is playing for. He wants to ensure that they just take the edge off of businesses and households, not reignite stuff. And I think his concern is if they don't do something soon, then the long and variable lags will start to catch up in a much bigger way. And the pressure that you're seeing on the lower half of businesses and households will continue to spread above the line into the top half.
Bob, how much cash is on the sidelines and where does it go?
There's a massive amount of cash on the sidelines. I'm surprised Lisa didn't ask me about all the Treasury issuance and what that did to the market.
Well, this is sort of the tee up for that.
Yes, thank you very much for that.
I like to be unpredictable.
I love that everyone talks about, oh, you can't touch the bond market here. Look at all the supply. I get loads of questions from clients. we're trading 100 basis points through the Fed funds rate. It's not like the Treasury curve is at 5.5%, 6% and heading north to 7%. So there's a lot of buying that's going on and willing to accept yields below cash. But we see three vast pools of money out there that are waiting for the yield curve to disinvert because right now they're comfortable in cash. The first are wealth management platforms. When I meet with clients of a private bank, they're comfortable in cash. They're getting 5.5%. Why do they need to go out on the curve? Sure, some money's leaked into the market, but when you look at the $6 trillion sitting there in cash, that's a lot of money that could still yet come into the market. And by the way, they've had the right trade to sit in cash for the last couple of years. When the Fed starts cutting rates, that comes in. That's the first pool. The second pool is banks. Banks are far better off keeping money in overnight reverse repo at 540, 545 than going out into the mortgage market, buying a combination of Ginnie 5.5s, Ginnie 6s, you've got that 575 blended coupon. You're only 30 or so basis points above overnight reverse repo, and you have all that negative convexity. Why on earth do you do that for a handful of basis points? So they're not doing it. And the last one, I was in Tokyo a couple weeks ago. I know you poo-pooed that because everyone goes to Tokyo, but you learn a lot being there in the ground.
I didn't say anything.
Listen, your producer told me there would be no hard questions on Friday mornings, and you guys have just fired 3 off.
One.
You fired 3 off. But it's foreign buyers. If you talk to the big Japanese historic investors in the bond market, they're saying, hey, the cost of hedging back to yen is 5.5%, and that's not your hurdle rate. 6.5% is your hurdle rate because we could put money in JGBs at 1%. When the yield curve starts to disinvert and retains the normal shape, that's the third pool of money that comes into the market. I think all of that money is in play from September on.
Got it. Very defensive this morning. Bob Michael of JP Morgan. Disappointed I'm here, apparently. Bob, thank you. Appreciate it. It wasn't about the auctions, it's about the inverted curve. Did you get that?
Yeah, I got that.
Okay.
Fully understood that.
It's
And
not
the
about
pools of
supply.
money.
Yes. Ready to be deployed.
Yeah.
When that curve starts to disinvert.
So sub 3%.
The Fed starts to cut.
I said, are we going to start to see everything kind of go down?
We sort of re-steepen and people want to buy it.
Mm-hmm.
Okay.
Okay.
Good stuff. Bob, thank you.
Always a pleasure to be here.
Thank you, sir. I hope. Ed Yardeni of Yardeni Research joins us next. Bloomberg's Woo Jin Ho, Lara Raim of SF Investments, and SocGen's Sabaja Rajappa. Your PCE data 34 minutes away from New York City. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's not unreasonable to worry about inflation.
We are seeing inflation come down. I think that when we look at the next couple of quarters, we'll probably see some ebb and flow.
We're kind of optimistic about inflation in the near term.
To get to that July cut, you would need probably some combination of soft enough labor market data and enough decline in the run rate for inflation.
The Fed's not going to be cutting rates because inflation is magically back down to target. They're going to be cutting rates because all of a sudden they have to start worrying about the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The next 60 minutes absolutely dedicated to financial markets. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. Equity futures are raising this morning's losses, down by about 0.1% on the S&P 500. Down on the session, just off on the week. After 5 weeks without losses on the S&P, we are still up on the month for the month of May on the S&P 500 and on the Nasdaq too. The next 60 minutes looks like this. 30 minutes from now, we will get PCE data in America. That is the last big data point before the Fed goes quiet. That's the good news. No Fed speak for the next week, going into the Federal Reserve meeting. Bramo, 2 Wednesdays away.
What I'm curious is how big is the market reaction going to be to what we get in about 30 minutes time, this idea of if we get a downside surprise on the key metric that the Fed looks at in order to get a sense of inflation, do we see suddenly the idea of a July rate cut cutting back on the table? I mean, how aggressive could you see, given all of the moves that we've seen recently to even peripheral data points?
There's a really strong argument to make this morning that what happens with prices this year is far more important to the outcome of November than what happened yesterday afternoon. Is that fair?
That is fair. When you look at the polling, the economy, and notably inflation continue to be top of mind of the American voters. And in our polling, what we've continuously see is that there is a trust deficit between the electorate and Biden when it comes to handling the economy. And a lot of individuals think that Trump would actually do a better job. When it comes to this conviction going into it, the electorate, it was muddy waters. Very mixed picture on whether or not this is going to change the outcome on how people vote.
Looking for more polling over the next week or so. I want to pick out a single name as we get closer towards the opening bell at about 90 minutes time. I want to look at Dow. Dow is down in the pre-market by 16%. And when you look at a move like this following earnings, you probably think there's a big miss. Big downside surprise on Dow earnings. Lisa, there wasn't. We're down by 17% because a beat isn't big enough in this market.
Okay, sales increased 6.3% to $22.2 billion. The estimate was 21.6 billion. This should be something that is rewarded. I guess the question is how many of the rewards have already been baked in, not just to Dell, but to other companies as well. And we've been talking about this throughout the show, and I think that it's a fair question, especially during some of the spotty and violent trading that we're seeing ahead of the market open. How much have we overpriced how quickly we can bring artificial intelligence to all these different sectors and create this incredible productivity wave at a time when we're still facing some really real pressures in terms of inflation, in terms of a weakening lower-end consumer.
We've had some great conversations in the last month or so. I'm just reminded as you speak of Jeff Caffrey of JP Morgan. And Jack pointed out that maybe he thinks that some of these trades look a little bit stretched. The fact that we started to pile into second derivative AI trades like utilities, which have had a pretty stellar month in the month of May.
Peter Scheer was speaking about that as well, but honestly, what he was speaking about, Jack, was saying, listen, people are looking at utilities, to permitting, how quickly they can get this off the ground, building it out. We were speaking with the CEO of Baker Hughes, and he was saying, yes, the electricity demand is going to be incredible, but right now it's acting as a vice on the potential percolation of artificial intelligence through the industry because there just isn't enough energy to supply some of the projections that people have on the other side.
And is there enough in the commodity space to support this? This is why Jeff Curry says copper is basically the best trade he's seen in his entire lifetime.
Speaking of punishment and big single name moves, I want to reflect on American from earlier this week. American Airlines down after cutting their outlook. The others didn't do the same thing. United affirmed their outlook. We caught up with Delta, the CEO, Ed Bastian, Guy Johnson in Dubai about 30 minutes ago. If you missed that, just the basic highlights for you. We're not American Airlines. We're still pretty constructive on the summer ahead of us. Yes, we have a more affluent consumer, but we're not seeing the trade down that maybe you're seeing at other organizations. They're not seeing that at all. That stock's going to be okay.
Which is a reason why people are saying it is an execution issue over at American Airlines. The other thing that Ed Bastian said was that business travel has really stepped up. How many people who have come on this set, every single one of them, I've been traveling so much.
Bob Michael, Japan.
To Tokyo.
But everywhere.
Dollar yen 160.
Thank you. You can carry on.
Everyone's going to Tokyo.
I know. Well, there's a reason for it. You think it's just because they've got good buying power with the currencies?
Dollar yen 160.
I think
that's the tourism. I know where the bond managers are going there. There's some income where there wasn't income before.
Correct.
They want to talk to Japanese investors about what they're doing now. I get that.
And suddenly the economy is doing well. But you're right. People are going there just like they're going to the south of Europe because of where the euro is.
Euro dollar sub 110, we'll take that. Dollar yen 160, we'll take that. You know, sort of a US bias here, but yes, we'll take it. Equities right now in the S&P down by about 0.1%. The opening bell in about 1 hour and 25 minutes. In the bond market, yields just about unchanged on a 10-year 455.21. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research on lofty expectations for the Magnificent Seven, Woo Jin Ho of Bloomberg Intelligence on Dow's mixed earnings report, and Lara Raim with PCE data about 30 minutes away. We begin with the big issue, heading towards a week of losses going into this morning's inflation data. Ed Yardeni of Yardeni Research weighing in writing this. If investors get a whiff that the lofty growth expectations for secular AI spending need to be lowered, they'll inflict swift punishment. Two S&P 500 sectors specifically would bear the brunt of the resultant price declines: information technology and communication services. Ed is with us now for more. Ed, do you think this move in Dow this morning speaks to exactly what you're flagging?
Yeah, I didn't expect that that view I had would be validated so quickly, but I think it was also Salesforce. I think suddenly there's a recognition that all those revenues that NVIDIA's accumulating and likely to accumulate come from increased capital spending by every other technology company in the world. And initially, that's going to be a burden on profitability, and there's not going to be an immediate payoff in artificial intelligence increasing productivity.
Ed, does that make you bearish at the single name level across some of these big names or on the broader market?
Well, I think it's actually a healthy development that the market is starting to recognize a more balanced view of what's going on in technology and the economy in general. I think what the market's recognizing is that it's not going to be straight up in artificial intelligence, and it's going to take a while, and it's going to be expensive. And by the way, so far, we know that artificial intelligence is artificial. We're not quite sure if it's that intelligent just yet. It does make a lot of mistakes, so there's a lot of work to be done to still perfect it. So put it all together, and yes, I think it validates our view that the market, we're still in a bull market, but it's going to be slowing down from here. We're looking for 5,400 by year end. A few days ago, people were asking me, why aren't I raising my numbers? When now I feel comfortable that I didn't.
But there is this larger argument, and I think it's fascinating that you're making this case because you have been bullish, but with the tempered reality of how quickly we can go to some of these technological advancements. There is a sort of tag on here about implications for productivity and some of the broader economic gains that come with AI adoption. If it's going to take a lot longer than we've currently baked in, well, doesn't that mean that some of our expectations of increased productivity, bringing inflation down, and some of the ballasts to the economic growth maybe not being as strong as they previously were assumed to be?
Well, I've been a bull on productivity for a while. I've been talking about the roaring 2020s based on the idea that there's a shortage of labor and companies are going to figure out ways to increase productivity. And I based that not on AI. I said there's enough technologies out there already that can increase the productivity of labor. And sure enough, last year it was a great year for productivity. It was over 2%, which is quite a strong move. And I think that's going to continue to be the case. So I think if we recognize that artificial intelligence is just part of that productivity puzzle, we'll have a more realistic view of what that technology can deliver.
And I know that you've also been saying that this is not an economy that needs rate cuts, and that if you do get rate cuts, you turbocharge potential inflation as well as some of the stock market moves that we've seen already. Right. I want to tie that to this idea of some of the pitfalls that we're seeing in specific names in technology. If the Fed were to cut rates, if we do see some sort of slowdown in inflation, and the Fed cuts rates, do you see some of these losses on these names actually retraced pretty quickly as people say, okay, well, it's cheaper for us to sort of bet on future growth at a time of potentially lower yields?
Well, I think that if the market starts to get a whiff of the possibility that the Fed put is back, then that scenario you just laid out could certainly play out very quickly. We were only a few days ago, maybe a couple of weeks ago, I had concerns about a melt-up, and now I'm less concerned about that because the market is getting more realistic about what technology can deliver. But yes, I don't think the economy needs rate cuts. I think rates are, sure, the Fed has tightened, but the reality is they've normalized. Interest rates are back to where they were before the great financial crisis. The economy was resilient back then. I think the economy is proving itself to be resilient right now.
But Ed, are you team Williams or Dudley in terms of sufficiently restrictive in terms of the economy?
Well, my own view is simply that these levels of interest rates, they're kind of where they should be. The Fed officials, Dudley and Williams, Dudley used to be a Fed official, but these folks still talk about R-star, this ideal level of interest rates at which you get an economy that's growing reasonably well with an unemployment rate that's quite low, with inflation coming down. Well, folks, that's where we are right now. We're in that nirvana situation, so why mess with success?
Ed, you are Mr. Bond Vigilante. I'd love to talk to you about that just a little bit. Sure. Had a bit of pushback from some of the auctions this week. I think we had about $183 billion worth across 3 tenors, a 2-year, 5-year, 7-year. Just wondering what you made of that this week.
Well, certainly it was an immediate wake-up call on the supply-demand issue. We had that issue back last year during August, September, and October, when the bond yield soared from 4.25% to 5% just in a very short period of time. And suddenly there was a recognition once again that the deficit really could be a serious problem and create a debt crisis. So I think we want to be aware of that. But I attribute this small backup in the bond yield, but not so much to the auctions as to a realization that the Fed really is in no rush to lower interest rates and that short-term rates could stay here for a while. Neil Kashkarian gave us that kind of new Fed playbook that he said that he wants to see the inflation rate stay low for several months. So even if we get a good reading here at 8:30, that doesn't mean the Fed's suddenly going to be in easing mode. I think Kashkarian's view is the Fed view that we need several months of inflation at our 2% level, and we're not there yet, clearly.
Ed, given the lack of visibility around 25, I just wonder what your best guess is now. Is it no cuts in 24?
Well, it's no cuts this year. That's still my view. At the beginning of the year, people were talking about 6, 7. I thought, well, 2, 3, and I was kind of, I still didn't understand why even there would be 2, 3, but I figured maybe I was missing something. But along the way, everybody's kind of come to the conclusion that maybe it's 1, 2, while I'm at 0 and a few others are at 0 rate cuts this year.
You've got company in Apollo's Thorsten Slog, that's for sure. Ed, thank you, sir, for this morning. Appreciate it. Ed Yardani there of Yardani Research. The Bob Michael explanation from JP Morgan, if you missed that, by the way, was with us about 15 minutes ago. I thought it was interesting. 3 pools of cash that at the moment don't want to go out along the curve because they don't need to. They can sit in money market funds and get paid, ultimately, 5%, more than that. Why would you go out along the curve, take an additional 10 years, go out to a 10-year for 100 basis points less? Why bother?
Basically, as soon as there's a normalization of the yield curve and you've got long end yields that are actually yielding more than short end yields, then all of a sudden these pools of cash will get unleashed and trillions of dollars, right, will come in. I guess then the question is, what will it take to actually normalize the curve? How many rate cuts, and is that feasible? And if not, do you see normalization on the other end, which is basically long end yields going a significantly degree higher?
It's the bull steepener that everyone was looking for coming into 2024 and just got pushed out pretty quickly. Equity futures on the S&P 500 down here by about 0.1%. Let's get you up to speed on some news elsewhere with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Torrential rainfall in Brazil has led to catastrophic flooding in the country's southernmost state. At least 160 people have been killed and 600,000 have been displaced. It's the third major flood to hit the region in just the last year. Local mayors are weighing the idea of relocating entire neighborhoods away from high-risk areas. Officials say it's still impossible to estimate how many areas will have to move their residents because the rainfall is still ongoing. Donald Trump was found guilty on 34 counts of falsifying business records to conceal hush money payments to an adult film star. Prosecutors argued that it was a conspiracy theory that deprived voters of vital information ahead of the 2016 election. Trump now faces as many as 4 years in prison when he is sentenced on July 11th. That's just 4 days before the start of the Republican National Convention. Boeing and U.S. aviation safety regulators will track 6 measures to judge the health of the company's production system. Indicators will include the number of hours spent repairing the aircraft during final assembly, employee skill at proficiency, and daily shortages of parts from suppliers. U.S. regulators vowed to maintain tougher scrutiny of the plane maker. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, we'll get you some morning calls, plus Woo Jin Ho of Bloomberg Intelligence on Dow's missed AI expectations. That conversation just around the corner from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Big economic data point about 12 minutes away, waiting for PCE data in America, the Fed's preferred gauge of inflation. Equity futures on the S&P 500 going into that print, negative by just 0.1%. Let's get you some morning calls. First up, Morgan Stanley raising its price target on Gap to 27. The analyst highlighting stronger than expected results across its brand portfolio, but noting an expensive valuation. The stock is up 22%. Next up, Mizuho raising its price target on Micron to 155. Analyst Vijay Rakesh saying the chip maker is well positioned as demand for AI smartphones and PCs is expected to increase. And finally, Barclays lowering its price target on Dell to 97. The analyst citing a miss on AI server expectations given the run-up in the stock, expecting more disappointing results in the future. Dow shares down by 16% this morning. Let's catch up with Woo Jin Ho of Bloomberg Intelligence, who joins us now for more. Woo, can we just start with those numbers yesterday? Where was the grand disappointment for this market, given that we've got a single name down here by 15, 16, 17 percentage points all morning?
Hey, John. So there's a couple of areas of disappointment for Dell. It was probably the backlog number. First of all, the backlog numbers came in at 3.8 billion. I think the whisper numbers were much higher, especially given where the valuations were at the time. And then the second is the AI server profitability. It's probably going to be more earnings neutral versus a more typical 9 to 10% server profitability. So, you're not getting any return on your AI server numbers.
Well, Jim, can we just finish on that point? I think that's so important. Just elaborate a little bit more on that. That came up on the call. I think it was Tony Sacconaghi who asked the question about the margins on these servers. Are we saying that where they're going to get the best revenue growth in the future is from a product that dilutes margins?
Yeah, and that was a brilliant question by Tony, quite frankly. And look, we have to keep in mind that we're still in the early days of the AI server boom, or the AI infrastructure build-out boom. And what Dell is coming up against is trying to gain footprint, and the best way to get early footprint is pricing. If we listen to Supermicro's earnings call about a month back, essentially what they said was that their margins were going to be a little bit dilutive from competitive pressure. There are a lot of deals that are out there, and the first to win those deals could probably have a long runway to win more server deals in the future.
Woo-Jin, we've been spending the morning wondering whether Dell is sort of indicative of a broader over-enthusiasm of where AI is taking non-NVIDIA companies. I don't know how else to characterize them, but they seem to be the global winner in all of this. Do you think that's right, or do you think that this is a Dell-specific story and how they're trying to win market share, and what sort of services and hardware they're providing?
Sure. So I want to take that question in a couple of ways, Lisa. If we look at Dell's forecast, what I back into is about an $8 billion annual revenue in AI servers. Roughly 2.2 billion of it is coming in next quarter. They already booked 1.7 or recognized 1.7 this past quarter. That revenue is flattening out in the second half of this year. Given that there is this huge pipeline of deals that Dell keeps on talking about, the gatekeeper of those deals is still NVIDIA because they still hold those valuable chips, right? And depending on where NVIDIA want to send those chips, the vendor wins. Now, the second aspect of it is valuation. Look, prior to the print, they were trading roughly around 21 times forward earnings. At the end of the day, it's a hardware company. Before this AI frenzy, hardware names were trading around 7 to 9 times. So you're getting a 10-point premium just for the AI alone.
Woo-Jin, this was great. It's good to hear from you, sir. Thank you. Woo-Jin Ho there of Bloomberg Intelligence. That name's down hard this morning. It was Morgan Stanley's Mike Wilson, I think, who said AI is everywhere except in the numbers. And of course, he was talking a little bit loosely about the broader equity market, but this is an example of that, isn't it? It's just not in the profits just yet.
If you strip NVIDIA out, it isn't in the profits. And what I find fascinating, and Mujin really highlighted this, is that NVIDIA holds all the cards, or all the chips, as you may, in terms of what they decide to charge, who they decide to ship it to, and it's their profits, not necessarily everybody else's.
Big move lower for that stock this morning. NVIDIA still positive in the pre-market. The broader equity market, about 1 hour and 8 minutes away from that opening bell. Erasing this morning's losses, still lower by about 0.1% on the S&P. PCE data is just around the corner. Bloomberg's Michael McKee with us in the studio, ready to break that down. Mike, what should we be all looking for in about 7 minutes?
Well, the one thing economists think is going to happen is that core will come in on a slightly lower basis for the month of April. And while that really won't affect the year-over-year trajectory, it will reignite the idea that inflation's going down and that the Fed can at least start thinking about cuts. We've heard over the last, I don't know, 72 hours or so, a lot of people at the Fed saying higher for longer, just going to stay where we are. And I don't think this number is going to change that, certainly not in the short run.
You know, it's sort of this compelling theory about whether Neil Kashkari kind of speaks for the committee in saying that now the threshold is a couple of months of data that cooperate. Is that really sort of a more mainstream view, or if we get a real downside surprise in this particular print, could that alone really increase the likelihood of, say, even a July rate cut?
No, I mean, it would change some thinking on Wall Street, but it wouldn't affect the way the Fed is thinking. Chris Waller has said the same thing as Neil Kashkari. They've all kind of said the same thing. We need a couple months to make sure that it's still going down, because if you got a big drop, that could have been some sort of one-off that then reverses the next month, and you don't want to be in a position to make a decision that you then have to reverse. So they're going to wait. The real debate now seems to be, are we tight enough? Because Lori Logan said last night, we may not be. She joins that camp. And then the question becomes, do you need to raise rates, or do you just need to leave them where they are for longer? And I think the majority of the committee is leave them where they are. And if you get any kind of numbers like we're expecting today, you can do that.
If we went here and you had Bill Dudley here and John Williams over there, and you had a nice little round table this morning going into this data, what would you ask them? What would you say?
Well, I guess you could ask what Bill sees as the reasons for why R-star, the neutral rate, is higher, and whether they will be sustained. Because the second part of the question is not, is it higher, but does that last? Or is this a temporary thing because of various things in the economy that you don't want to overreact to? So that would kind of be the issue. John Williams, obviously, you can ask him what R-star is, since he's the guy that invented the index.
Exactly.
But it hasn't worked, basically, since the pandemic.
It's the round table we all want right now, right? Williams, Dudley, let's figure this out.
Just introduce them and let them hash it out.
Just let them go. They're very polite individuals.
You and him fight.
I don't think those two are going to fight, but, you know, we'll try and make something happen. An intellectual battle.
Correct.
So sophisticated here at Bloomberg, aren't we? PCE data coming up next. Equity futures down just a little bit from New York. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Inflation data moments away, just about 20 seconds away or so. Here are the scores going into it. The opening bell about 60 minutes away. Equity futures on the S&P negative by 0.06%. On the Nasdaq, we're down about 0.2. Quick snapshot of the scores in the bond market for you on a 2-year and a 10-year. The 2-year at the moment, 493.52. On a 10-year, we're at 454.61. With that inflation data, the PCE deflator, here's Mike McKee. Mike, what have we got?
Well, you've got the income and spending numbers have dropped, although we're waiting for the deflators, but 0.2 gain in personal spending, lower than the 0.3 forecast and certainly down from 0.8 in the prior month. The personal income number is 0.3 exactly as forecast, but also down from 0.5. We want to break that down because we have had some movement in incomes that you never know whether it's wages and salaries or what else. All right, so now we have the inflation numbers. The deflator, the PCE headline comes in up 0.3 as forecast, puts us at 2.7% year over year as forecast, and that's what it was last month. And we do get the 0.2 for the core, which leaves us at 2.8%. So we are like bang on, and I think PCE has become one of the numbers that economists just get right because they get the inputs from CPI and PPI and they put them together, and we have been on point with this for a long time.
No bad news is good news. We've said this a few times about the inflation data. A meet is a beat. And right now, equity futures at the moment are positive by about 0.13% on the S&P 500. If you turn to the bond market, quick snapshot of how things are developing there. Yields pulled back just a little bit, down a basis point or two on a 10-year at 4.53. At least on a 2-year, came really close to 5% this week. Now back down to about 4.91, 4.92.
And just sort of as an interesting note, one thing that I've been waiting for is the revisions, and they came in actually also with a downward revision. So in other words, not only did personal income and personal spending come in, personal income as expected, personal spending lower. It also was revised lower in the prior month. So to me, it sort of indicates maybe the consumer is losing enough steam to give people confidence that we're on this disinflationary trend. At least on the margins, that seems to be what the market is reacting to.
The core deflator month over month coming in at 0.2. The survey, 0.2. The median estimate in our survey here at Bloomberg, year over year coming in at 2.8%. In our survey, 2.8%. Mike McKee, we're going to the quiet period from today into next week. No more Fed speak. You get a little break. How do you think this changes things in any way, shape, or form going into not next Wednesday, but the following Wednesday?
No way, shape, or form does this change anything because it was what was expected. It shows that there's still progress, that the economy is slowing but not falling off a cliff, which is what's supposed to happen when the Fed raises rates. So they're going to say, we're on track. This is what we expected. It tells us that inflation is still going down, but we need to continue to see more progress because we're only at 2.8. We got to get to 2% or maybe 2.4, 2.5. You can ask our guests in just a second what they think the starting point will be, because Jay Powell and others have said we're not going to wait till we get to 2.
I like what John says, which is a meet is the new beat. And I think that it's absolutely the correct theme, especially when it comes to inflation data. On the margins, there also is this sort of miss in the right direction in terms of personal spending, at least if people want to see cooling spending. What do you make of the fact that revisions are so frequently downward these days, that we get these data points and that they're revised, sometimes significantly, sometimes not, but usually in a downward fashion?
Well, there was an old rule proposed by Larry Meyer when he was on the Fed that if you get a surprising number, the revision is going to surprise in the same direction. And lately, that's what we've been getting in the employment numbers that just changed last month. We'll see if it continues. And so we get a little bit of this where we've seen, surprisingly, all of a sudden weaker growth. But it shouldn't be surprising, I guess, because that's what the Fed's been waiting for. The surprise was that it didn't happen sooner.
The surprise was Q1, and we're trying to work out whether Q1 was a head fake or not. If you are just joining us, welcome. Had PCE data about 3-4 minutes ago. This is what it looks like. The core PCE deflator comes in at 0.2% month over month, bang in line with estimates in our survey here at Bloomberg. Year over year, 2.8%, bang in line with estimates, 2.8%. Equity futures just about positive by 0.2%. On the S&P 500. Picture of bonds for you, which have been all over the place this week. Yields up a little bit on soft auctions, down a little bit on what BMO's Ian Lincoln called bond-friendly economic data. Get a bit more of that this morning, apparently. We're down about 2 basis points on a 10-year, 452.82. You got a final word, Mike?
Yeah, when we look at the income numbers, wages and salaries were only up 0.2 after a 0.6 gain in March. So wages and salary growth is slowing, which is what the Fed wants to see. They've been afraid that we would see continued upward wage pressure. And as the labor market loosens, that kind of comes off. It also suggests that you get disposable personal income up only 0.2, and on a chain basis, on an inflation-adjusted basis, it's down 0.1. So suggests spending may be weak going forward as well.
Let's get to the guest panel with futures positive, 0.25%. Laura Rame of FS Investments is with us alongside SocGen's Subhadra Rajappa. Laura, let's start with you. Your reaction to this data, you've had 5 minutes to chew over it. What stands out for you?
So, we've had now sort of 4 months of unfriendly inflation data and growth really continuing to surprise to the upside. Today's got to be a huge relief because some of the early numbers for April were really confirmed by this broader look and this broader data. So, this is a more dovish report. I feel like you have to acknowledge that. I do notice the slowdown in spending, especially the real spending. We're starting to get data for Q2, and, you teased that going into this, but we had still peeling back the headline number of Q1, the underlying data was fairly strong. I think we're now waiting to see how Q2 shapes up. So far, it looks like it's also going to be a little bit slower. I think the landing may be really sort of orchestrated in Q2.
Subhadra, is that landing in sight?
We think that the Fed's going to stay on hold for the remainder of the year, and this data point doesn't really push. There's no sense of urgency, I think, from the Fed. With the inflation starting to ease up, growth is starting to come down. But we heard from Williams yesterday, and he's expecting growth in the context of 2 to 2.5% for this year. Inflation, core PCE heading towards 2.5% by the end of the year. There's really no urgency for the Fed to cut rates anytime this year. I would say the earliest that we were looking for the Fed to cut rates is after the elections at the December meeting, if the data requires them to do so.
But Subhadra, on the margins, given the fact that this isn't necessarily a game changer, but it does confirm this idea that maybe the disinflationary trend is back on track, does that give you more conviction, actually, with some of your closely held beliefs, this idea that you should buy bonds, particularly the longer end, and that inflation will come down, and that we will essentially normalize?
You can buy bonds in the long end, but it's really much more attractive to hold front-end treasuries because the yields are way more attractive. And that's exactly what you're seeing investors. I mean, you're seeing AUMs in money market funds at $6 trillion. Money is going into the very front end of the yield curve just because returns look very, very attractive and the yield curve is inverted. And I think that trend is here to stay until we know that the Fed is going to be cutting rates aggressively. And this is really when it gets a little bit tricky for me, because you look at the policy path that's priced in the markets, you're looking at very few cuts between now and the middle of next year. So you're looking at less than 100 basis points of cuts by the middle of next year. So that still argues for investors to continue to plow money into the very front end of the yield curve, not so much in the long end.
Laura, this raises this sort of larger question, which is, does it really matter if the Fed cuts rates once, right? I mean, this is the issue that we have with the ECB as well. Are people looking for evidence of a real slowdown that could lead to a protracted rate cutting cycle? Based on what we're seeing now, does this data go anywhere near beginning to move us in that direction?
Yeah, and maybe I'll take that question in a slightly different direction, because I agree, 25 basis points especially given where we are at, over 5.25%, is not going to move the needle tremendously on interest rate sensitive sectors of the economy. I think the question to me is, we're probably not focused enough on growth, which has been so strong at 3%. Expectations of higher growth are now so built into markets. Nominal GDP growth of 6% turns out is enough to power equities higher, even though rate cut expectations have been ratcheted very far back. So going forward, if that slows to 5%, this isn't a big slowdown, but I think, we need to pay attention to the fact that so much growth is priced into earnings expectations, and there's so much optimism priced into markets. The two-way risk on growth numbers are now really significant. We haven't seen that in a year and a half.
Laura, before we run away with the conversation about growth, can we just sit on inflation just for one beat longer? You've been saying for a while that we'd get stuck around 3%. Are you rethinking that?
I'm not. I still think that at the end of the year, we're going to see rent inflation pressures continue to creep back up. And I think we're going to see the inflationary process really stuck around 3%. I don't think that stops the Fed from cutting if the economy slows a lot, but I think it makes it very hard to maneuver in a place where we're still growing at 2.5%.
Mohamed El-Erian's been on this program and he talks about stagflationary winds. Laura, are you thinking about stagflationary winds at the back end of this year?
Today the economy looks really solid. I'm not too worried about it because business investment is going to ratchet back up again. I think we're in a good place for the economy. I'm trying not to overthink it too much.
Mr. Patrick, are we overthinking it? When you say no rate cuts this year and you're looking at inflation, what does growth look like at the back end of 24?
Probably going to gradually slow down as we progress through the remainder of the year. We're not overthinking it. I think the simplest path is for the Fed to stay on hold for the remainder of the year instead of kind of the conundrum that the ECB is in right now where, the market's pricing in for a June cut and then the debate on whether they're going to cut again in July, whether they're going to cut again in September. So the sort of volatility of expectations is really what's confusing investors. So to me, a very straightforward path is for the Fed to stay on hold for as long as they possibly can and then embark on maybe a cut a quarter or some sort of a very stable, steady path of rate cuts from then on as opposed to this back and forth.
Laura really raised this two-pronged idea of both inflation and then this idea of growth. And what happens if you start moving out of the inflation being offset by strong growth to maybe not stagflation, but inflation not being offset as much. Subhadra, does that make you, if there is clear slowing in growth, clear growing in spending, a little less sanguine about riskier securities within fixed income just because you both have rates on hold, still enough inflation to make the Fed nervous, but an economy that just doesn't have the same kind of juice in it?
Yep. Because of that, that's one of the reasons why we think that across the yield curve, yields are going to struggle to get above that 5% level. 2-year above 5% is going to require a much more different stance from policy. The Fed either has to hike or not cut for the next couple of years. And for the 10-year to get above 5%, the market is always going to be looking towards growth slowing down in the second half, and that's really going to cap the rise in yield. So even though we've had these discussions about R-star and whether R-star is a lot higher and whether debt and deficits start to matter, I really think that the focus, at least for the second half, is going to be on the slowdown in growth, and that's going to really cap the rise in yields. 10-year yields are going to struggle to get to 5% this time around.
Where are you on the R-star debate?
There's a case to be made, and I'm very sympathetic to the comments we've had from both Bill Dudley as well as Lori Logan that maybe R-star is a lot higher, at least a short-term R-star might be higher than what we're hearing from Fed President Williams. But the question is, how can the Fed actually act on that? Because what they really need to see is the data support a higher R-star. So we'll find out in maybe 3 to 4 years where R-star is today. It's really hard to know where it is right now as it stands.
And Laura, this sort of goes to this framework of it's hard to know where the end zone is going to be, also just in inflation. As John was mentioning, you think inflation is going to remain stuck at around 3%. What would you have to see to rethink that? We have Neil Dutta coming out this morning with a note after this data came out, just saying, every month this year has seen month-over-month core inflation lower than the same month in 2023. What happens if this pattern holds into the summer? Is that something that could make you rethink this idea of 3% as sort of the sticky spot for inflation?
I think, to me, the problem is that we really we don't remember how much everything had to go perfectly to get inflation at 2%. You know, today we've got commodity prices really moving higher. I think rents are going to reaccelerate. Ironically, high Fed, really restrictive Fed policy has stopped home construction, which is what's needed to help, unravel this whole real estate sort of stagnation and stuck at higher prices environment that we're in. Long story short, when you put it all together, we may well, see inflation dip a little bit lower, but I think my forecast is a longer run problem of stubborn inflation above 2%, kind of the mirror image of where we were for the 5 years before COVID, stuck below 2%.
I always feel like Neil's regulating us, don't you? They always feel personal, those emails.
Totally.
Sent them out to clients, just saying.
Yeah.
I feel like they're sent to us directly.
It feels like he watches us and then screams to the screen when I speak. Like, you have no idea what you're talking about, Bramo.
Just saying, which is basically what he's done on this program before.
That's why.
Although you're both friends, apparently. I kind of believe that. Let's look ahead to next week. ECB next Thursday. Then we get the payrolls report. In our survey right now, keep giving you a sneak peek. Here's the latest. 180,000 is the median estimate in our survey. Previous number, 175. So, Badger, can we talk about next week, both the ECB and a payrolls report? And let's start with payrolls, and we'll finish on the European Central Bank in a couple of minutes. What are you looking for from that report next Friday?
So our economists actually have a slightly higher forecast, if you will, for payrolls than the consensus. So I wouldn't be surprised if you get a 200,000-ish number. The unemployment rate is going to stay below 4% for perhaps the remainder of the year. So very strong employment report is again what we're expecting for next week. But if there's any misses, that's when the market's going to react. The market's going to shrug off an upside surprise, I think.
Laura, do you agree?
Yeah, I agree. The market seems to have happy ears right now. They want the rate cuts. That's the news that they react to more than, anything that would sort of push those back. At the end of the day, when we look ahead to rate cuts and when that could happen, we're starting to push up against the election calendar. I think we're just going to kind of give up the ghost slowly on a rate cut before the election and really focus on those December, maybe November meeting.
I'm not sure down investors have happy ears, but I get your point. Laura Raim of FS Investments. Laura, thank you for that. So, Badger, I just wanted to give you the final word on the ECB. Big conversation around this table about central bank divergence. The limits of that divergence, how far can this ECB go without the Federal Reserve?
So I think our European economists said it best, which is it's data independence. I mean, the Fed and the ECB is already committed to cutting rates in June, and they're going to do it, even though the inflation data that we got recently doesn't really justify them to cut rates in June. The question really becomes what comes after that. And to me, what really dictates the price action in the bond market is this divergence between the ECB and the Fed. I think that's going to keep rates between the U.S. and Europe diverging as well, because the Fed's going to stay on hold for the remainder of the year, and the ECB is going to still be biased towards cutting rates.
We came into this week saying it was going to kind of be a sleepy week. You could make your argument about whether it was or wasn't, but next week is going to be actually massive when it comes to both the JOLTS data, the payrolls. We've got, of course, the ECB.
You're excited about
Thursday.
next week?
I am excited. Yeah, I'm excited. Okay. So I just want to know what you're most excited about of all of these potential data points. The ISM data, we get manufacturing and services.
So I'd start with JOLTS. I mean, if you look at the job openings, we really want to see that head towards that pre-pandemic level relative to the number of unemployed. So that's a very important first metric on jobs. Beyond that, I'd be looking to hear from the ECB and what they're thinking about policy, not just for June, but beyond for the remainder of the year. And then payrolls. Payrolls is very, very important. And whether we keep that momentum that we've had throughout this year is going to inform us on whether the Fed is going to look at perhaps cutting rates in July or September, which is not our base case, but that's something that we'll be looking towards. The Fed really wants to see the job market cool off as inflation is coming down as a justification to cut rates, and they want to see that data soften.
We are hitting the ground running in the month of June. We will have an engaged Lisa, I promise you, Monday morning.
Are you saying I wasn't?
Samantha, thank you. Just not on the politics, not this morning.
I mean, I'm not.
We know how you feel about it all. I know how you feel.
Well, I don't think I'm alone.
You're not.
Okay, good.
I think there's a good chunk of the country that feels the same way. We talked about the double haters.
Yeah.
I think it's a very real thing in this country right now.
Okay.
Looking ahead to economic data, jolts, job openings, good stuff. Equity futures on the S&P positive by 1/3%. Let's get you some news elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, a quick check on Gap for you. Surging in the pre-market nearly 25%. The retailer reported first quarter results that topped estimates and raised its outlook for the full year. All of Gap's brands posted comparable sales gains and outperformed expectations. The company added Zach Poston as its creative director back in February and has turned to celebrities to boost visibility. Anne Hathaway and Divine Joy Randolph sported Gap dresses at recent fashion events. Paramount Global shares also rising in the pre-market, only 0.5% though. That follows a report that Skydance Media submitted a sweetened offer for a merger with the company. Paramount's independent committee is set to review that offer shortly, that according to the Wall Street Journal. In recent months, Sony, Apollo, Warner Brothers Discovery, and media executive Byron Allen have all expressed interest in Paramount. Apple is planning to overhaul its Siri virtual assistant using more advanced AI. Bloomberg reports the move will allow users to control the functions within app functions with their voice. The upgrade is one piece of Apple's larger AI strategy, which is set to be unveiled at the company's Worldwide Developers Conference on June 10th. And that is your Bloomberg Brief. John.
Danny, thank you. Thanks for this morning. Have a great weekend. Up next on the program, setting you up for the day ahead. You're watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Equities near session highs, up 1/3% on the S&P 500, counting you down to the opening bell. Here's the trading diary for the week ahead. Monday, US manufacturing PMI. Tuesday, jolts and durable goods. Wednesday, ADP jobs data. Thursday, an ECB rate decision plus another round of jobless claims. And on Friday, the payrolls report. And you'll notice on this screen, no Fed speak, quiet period. Going into the Fed decision, 2 Wednesdays away. Before we get to June, we need to wrap up May. Let's start with the stock market. Some of the standout themes: the AI wins and misses, 1. 2, the 90s renaissance that we're seeing in retail. Abercrombie & Fitch, Gap this morning, absolutely surging. We could talk about the airlines too. A lot going on in this equity market in May.
To me, the big takeaway is there's a shift of momentum. We're not necessarily seeing the melt up in the same kind. And that, I think, is really probably the big takeaway.
Would you have guessed that Dow would be an AI miss this month and that things like utilities would be AI wins, the standout of the equity market so far this month?
I mean, if I said yes, you would laugh
Kinda
the whole way
shocking,
out
right?
of here. It's
Kinda
completely
shocking.
shocking because people don't have a handle on how quickly this can be rolled out, how feasible it is to get all of the elements like copper to really build out some of the utilities and the infrastructure. But there is a sense there is a sea change underway. How do you bet on that is really now the big question.
The big word this year, and there's been many, but bifurcation, I think, is one with the consumer. And bifurcation that we're seeing now within industries, too. The winners in retail, the losers in retail. Coles, a loser. The winners, we've talked about those already. In the airline business as well, American, a loser. Everyone else, Delta, United, doing better. That's been a theme through May and potentially going into June and beyond.
And there are two aspects to this theme. One, who can cater to the high-end customer better, right? Who can keep that customer base? And two, who wins? Because there's a shrinking pool of cash, at least on the lower end. So who's going to win on that? Is it going to be the Walmarts? Is it going to be the Costcos? Is it going to be the Dollar Generals, which actually came out with better than expected results?
How is the consumer doing? Big payrolls report next Friday. Looking ahead to that, lots of economic data going into June. Also, we're really kicking off the election season now for November with that first debate at the end of next month.
End of next month, the first debate, and then comes the sentencing for Trump's verdict yesterday. And that's going to be on July 11th, and then just around the corner, a few days later, the RNC, where he's going to officially become the Republican nominee for president. And, you know, it really kicks off today, I think, at 11 a.m. Trump will be giving a press conference, and his message is likely going to be similar to what it was last night. This has to now do, the verdict really comes down to November 5th with the American people.
And how the president navigates this issue over the next couple of days, the next few weeks, going into that big debate.
It's going to be fascinating. We're all going to be tracking every single move of it.
I don't buy that from you.
You know, the problem is it's not going to change anything. That's what everybody's been saying.
You're not alone. You've got company. They're frustrated too. Coming up on Monday, United Airlines CEO Scott Kirby, Michael Kushner of Morgan Stanley, Cameron Dawson of New Edge Wealth, and Marriott International President, CEO Tony Capuano. AMH taking a little break. Enjoy.
Thanks. Looking forward to it.
From New York, this was Bloomberg Surveillance.
Welcome back to another special Roland Garros update for Bloomberg TV and Radio. From Tennis Channel, I'm Andrew Guy. World #1 Novak Djokovic dialed in his game as he swept past Roberto Carballes Baena in straight sets to reach the third round. The three-time champion thrilled the crowd as he dominated the Spaniard from the very first ball. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, I'm Katie Greifeld. PCE providing some needed relief to this market. You can see a lift in futures right now. The countdown to the open starts right now. We begin with the big issue. PCE comes in right in line.
We think that the Fed's going to stay on hold for the remainder of the year, and this data point doesn't really push. There's no sense of urgency, I think, from the Fed. With inflation starting to ease up, growth is starting to come down. But we heard from Williams yesterday, and he's expecting growth in the context of 2 to 2.5% for this year. Inflation, core PCE heading towards 2.5% by the end of the year. There's really no urgency for the Fed to cut rates anytime this year. I would say the earliest that we were looking for the Fed to cut rates is after the elections at the December meeting, if the data requires them to do so.
Joining us now, of course, we have Bloomberg's Michael McKee. And Mike McKee, it looks like pretty much on every line we hit the estimate.
Yeah, economists are pretty good about PCE because they get a lot of data ahead of time they can fold into their calculations. And it comes in as forecast, a little bit down on the core, but overall good news for the Fed because inflation didn't go back up again. And as you can see, it is leveled out. It hasn't moved down in the last 2 months, but that's progress given what we'd seen in the first 4 months of the year. So the Fed is going to be reasonably happy with that. The spending numbers also a little bit of a concern, maybe or maybe not, because the Fed expected the economy to slow when it raised rates, and spending up only 0.2 in April. So that is lower than we had seen. Incomes were not up as much as they have been. The wage calculation within that up only 0.2% after 0.6 the prior month, and that is also something the Fed has been hoping to see. Now, we're not running ahead of inflation with wages this past month, but on a year-over-year basis we are, and we'll have to wait and see when Americans start to realize that or feel it, and we'll see what the consumer sentiment indexes show. One interesting note, Katie, I always like to throw this out there when we get these PCE numbers. They do a calculation of portfolio management fees, and portfolio management fees are still driving inflation higher. You can see with the S&P up as it is, 0.7 gain, big gain in inflation in portfolio management. I call it the POGO problem. We've met the enemy, and he is us on Wall Street. And then finally, we leave you with the ongoing debate about where we are. It's not really so much a question of when do they cut rates. Everybody knows it's not going to happen yet, but do they need to do more? Lori Logan, the Dallas Fed president, out last night, joining the camp of people who say that policy may not be restrictive enough, which is going to raise some fears on Wall Street, and her view directly opposite that of her old boss, John Williams, who's at the New York Fed, who said that there's ample evidence that policy is restrictive enough. So we'll see how that debate plays out. Unfortunately, not till after the next Fed meeting, because I know everybody will be happy to know the blackout period starts tonight.
Well, Mike, just quickly, you went exactly where I wanted to go, and that's what we heard from John Williams yesterday. He also said that we don't need to be at 2% inflation to lower rates. He expects inflation to reach 2% in early 2026. So between now and early 2026, I mean, when's the first rate cut?
That'll be a good question. If we see the same progress probably towards the end of the year, and the Fed will take it slowly after that, after they do one, they'll wait and see what happens. But they've always said, and Jay Powell's emphasized this, they would start before getting to 2% because they don't want to end up behind the curve and send the economy into recession. So your guess is as good as mine, 2.4, 2.5, when they might start thinking about it.
All right, so stay tuned. Mike McKee, it's great to see you. Happy Friday. Let's keep this conversation going right now with John Stoltzfus. He is the Oppenheimer Asset Management Chief Investment Strategist. So let's talk about the Fed, because we have a central bank that's probably not going to hike rates from here. It probably can't cut yet, but it would certainly like to. So what's the playbook with that sort of setup?
Well, Katie, thanks for having me on the show, first and foremost. Next thing is this is really what we were looking for in that coming into this year, when the Fed had intimated at the end of last year that it likely could cut 3 times this year. We thought it would be 2, so we weren't with the crowd that was going 5 to 7. I think somebody even had an 11 in there somewhere. We were watching it like hawks. And we think that the Fed is doing the job. It's on the case. It's bringing down the level of inflation, evident by the numbers today and over the last couple of weeks. But inflation is still an issue. Jerome Powell does not want to be, he doesn't want to be like the predecessor of Paul Volcker. You know, he doesn't want to be an Arthur Burns. And so there'll be caution. We think the Fed cuts likely at least once, maybe twice at the end of the year, just to show the market that enough is enough, not that there's a recession pending or that they find themselves in a recession.
And I'm curious, when it comes to rate cuts, I mean, is this a market that truly needs them at this point? You think about how much has been priced out when it comes to the Fed's trajectory, and here we are pretty much at all-time highs.
Question, Katie. I would have to say here, we think it's when it comes to rate cuts, there's a lot of players in the market who would love rate cuts, particularly those who depend on high leverage. The VIG is costing them a lot more than it used to. Mistakes are more costlier. The right calls for the leverage crowd are less rewarding. But where we are today, it looks like a normalization of interest rates. I agree with Mike McKee. From what I understood, what he said there, it was like essentially we're normalizing. And I think in that the good news is, at long last, bond issuers pay for the privilege of borrowing money. And we think it actually adds some stability within the markets.
So I want to wrap this conversation into your year-end price target. Last I checked, you're at about 5,500. The average on Wall Street right now is just below 5,100. We closed at about 5,200 yesterday. What gets us to 5,500 by the end of the year? Can big tech do it alone?
I think it really has to do with a continued evidence that the Fed is making progress after, 11 hikes and 7 pauses, and likely a few more pauses before this is over, and revenue and earnings growth with a particular eye on the S&P 500. Q1 thus far, with 98% of companies having reported, looks like almost 8% earnings growth on back of, 3-4% revenue growth. And you've got 8 sectors reporting positive earnings growth, 6 of those 8 double-digit earnings growth, only 3 sectors showing negative earnings growth. Those happen to be, by the way, healthcare, materials, and energy. So you've got a lot of growthier issues and a lot of value issues that are actually delivering the goods in terms of exceeding expectations. So that's what you need. It's the Fed and earnings, consumer resilience, and job growth, or job posting resilience. All of that, a mix of that will take us to 5,500 and maybe higher, Katie.
Well, when it comes to the sector level, like you mentioned, I mean, energy, healthcare, it feels like they just can't get off the floor. But looking at it through an earnings lens, it's interesting, as you point out, several sectors posted double-digit earnings growth. That kind of broadening out, you haven't necessarily seen in the actual share performance. But do you think that's coming?
Well, I think the reason why we haven't necessarily seen it in the share performance, I'm particularly thinking of consumer discretionary, where you've got double-digit earnings growth. I think what it is the market still doesn't quite believe it. We tend not to bet against the American consumer. The American consumer spends like a sailor after a long tour of duty on shore leave when times are good, and when times are slow, they bring out the vacuum cleaner and get the coins from behind the sofa, from behind the back seat of the automobile or the trunk, and they keep spending, although they will spend at a slower pace. But whether it's good or not, it has to be good for the economy. So we'll continue to believe in the consumer in the U.S.
A great illustration there of that consumer. And I take your point, hard to bet against that. But then you take a look at the S&P 500. We're up, what, 10% on a total return basis. You compare that to the Dow Jones Industrial Average. I tend to think of that as the old economy, more representative certainly than what we're seeing in the S&P 500. The Dow Jones, it's close to erasing all of its gains for the year. I mean, how do you square that circle?
Well, some of it is, when you look at the Dow Jones, one of the problems is, as you know, as a portfolio manager, Oppenheimer doesn't like me talking about individual stock names, but I can certainly go into the sector within industrials. It's a commercial and defense aerospace maker that's had problems, that's really dragged it down, and also a software company recently on earnings that's one of the key components of software and technology for business these days. There was a disappointment, and the market tends to be fairly brutal. With two of those, plus you've got energy and healthcare well represented among 30 stocks. Well, that kind of takes it why the Dow is, just as you said, it's the older indices, and you really got to look at the S&P and the NASDAQ, the mid-cap S&P 400. And for the future, once the Fed gets to cutting rates, probably the S&P 600 and the Russell 2000.
By the way, I think we can name names here. Boeing down 33% year to date, certainly no friend to the Dow. So point taken there. I am curious, before I let you go, we're about halfway through 2024. What is your highest conviction right now heading into the second half of the year?
Highest conviction related to monetary policy remains on track to do what it needs to do. And the resilience likely to be reflected in outperformance by technology, communication services, consumer discretionary, and the industrial sector if the administration ever gets around to spending that money to building out the infrastructure significantly.
All right, John, always great to speak with you. Really appreciate your time. Our thanks to John Stoltzfus of Oppenheimer Asset Management. Have a great weekend when you get there. But joining us now for a look at the stocks moving ahead of the opening bell, let's turn it to Abigail Doolittle.
Well, Katie, before we take a look at the stocks that are helping the U.S. futures turn higher after that PCE number, let's take a look at one stock that's really hurting, and that is Dell. Shares down 16% in the pre-market. I believe this will be the worst day for the company in its greater than 5-year trading history. And this, of course, after they beat, but the expectations were very high. The AI server backlog failed to impress, plus the sales growth is hitting margins both that were and future margins. Turning to some stocks that are trading to the upside, though, in fact, Gap is absolutely soaring. This after they blew it out of the water, a great quarter. They also raised the outlook. Athleta and Old Navy doing really well. NVIDIA up 2.2% despite the Bloomberg scoop yesterday that the U.S. is reining in AI chip sales to the Middle East, so we have some strength there. And then, Katie, take a look at DJT, Trump Media. Shares are now trading higher. This, of course, after history was made. The former president was found guilty and convicted of 34 felonies. Relative to that stock, I believe it is now up 200% on the year. There is a 7.5% short interest. Of course, one of the more difficult stocks out there to short, but there it is, up 5.7%, Katie.
Yeah, quite a turnaround there. Of course, DJT initially plunged 15% after the verdict was read yesterday, but as you mentioned, Abby, higher now. Abigail Doolittle, thank you so much. Now coming up, as we just mentioned, former President Donald Trump found guilty.
Donald J. Trump is guilty of 34 counts of falsifying business records in the first degree to conceal a scheme to corrupt the 2016 election.
We take a look at the next steps for the former president next. This is Bloomberg.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Donald J. Trump is guilty of 34 counts of falsifying business records in the first degree to conceal a scheme to corrupt the 2016 election.
This was a disgrace. This was a rigged trial by a conflicted judge who was corrupt. It's a rigged trial, a disgrace. They wouldn't give us a venue change. We were at 5% or 6% in this district, in this area. This was a rigged, disgraceful trial. The real verdict is going to be November 5th by the people.
Well, Donald Trump becoming the first former U.S. president to be found guilty in a criminal trial. He now awaits sentencing, which is set for July 11th, which of course comes just 4 days before the GOP convention. Joining us now for more is Bloomberg's Anne-Marie Hordern. And Anne-Marie, needless to say, that is a tight time schedule.
Oh, yeah, absolutely. The calendar gets really interesting, especially as we have that CNN debate at the end of June. And we're going to hear from the former president, Donald Trump, this morning around 11 a.m. And what he is really going to say likely is what he said last night. And also, potentially, this is the point that him and current President Joe Biden agree upon. The fact of the matter is the verdict will be November 5th when the American people go out to vote. So this is all going to be about campaigning from now until November 5th. But this verdict, the question is, does it change the minds of the electorate? And really, when you look at the polls, you see the electorate that is quite fickle. And I look at 2 polls that were very interesting. One from PBS News and NPR. They have 67% of voters said a conviction would make no difference for them in November, including 74 of independents. That is key. It's the independents that each of these men need to win over. But then when you look at a Marquette Law School poll that came out just before the conviction, they found that voters said a guilty verdict would produce a 4-point lead in a national poll head-to-head matchup with Trump, while a not guilty verdict would have resulted in a 6-point Trump lead. So really now, Katie, it's going to be about the messaging.
Going to be about the messaging. We'll see if that sways any of those undecided voters. But like you mentioned, we hear from Trump at 11 a.m. this morning. But what have we heard from other Republicans after that verdict?
Well, a lot of Republicans, for the most part, are standing behind the former president, and they're taking his line that this was a sham trial that should have never happened. And they really are backing the former president. A lot of them like to point to the fact that New York is a very deep blue state, so they have questions about what this jury is. But we should note, the jury decided yesterday, and they decided that he was guilty on 34 counts for falsifying these business records about giving hush money to an adult film actress. But again, when you look at what Biden is saying, you look at what Trump is saying, both are talking about the fact that this is going to be decided on November 5th. And what they are doing, Katie, at this moment, and they did immediately yesterday, is they are off to the races in terms of donations, and they are both trying to campaign off this verdict.
Well, like you said, of course, the real verdict comes in November. Our thanks, of course, to Bloomberg's Anne-Marie Hordern. And like she said, of course, Republicans still standing behind Trump. So, too, are big wealthy donors. Let's talk about those wealthy Wall Streeters still backing Donald Trump, no matter the outcome of his court case. Joining us now is Bloomberg's Sridhar Natarajan, one of the authors of today's Bloomberg's Big Take. And let's name some names here, because he certainly has some wealthy, deep-pocketed donors on Wall Street.
Steve Schwartzman, Howard Lutnick, Omid Malik. These are some names that have been out there throwing their weight behind the former president, wanting to bring him back into the White House. And the context here is really important. It's historic not just because the former president was found guilty, but it was also the first criminal trial of a former president. In any other circumstance, in any other era, in any other generation, you would have seen a lot of these names trying to distance themselves from the individual involved here. Instead, most of these deep-pocketed backers are using this as a rallying cry for Donald Trump. And the fascinating bit for me here is these are the captains of the industry who've built, grown, acquired, accumulated wealth based on their belief in the legal system, the bedrock of capitalism in this country. And yet many of them are coming out and questioning how justice was carried out in this case.
And what's their reasoning? I mean, like some of those quotes showed, the verdict isn't going to change their opinion in any way. I mean, what do they see in Donald Trump, or what don't they see in Joe Biden?
Look, some of them have always stuck by him. Some have been reluctant travelers, and some have newly embraced the Donald Trump fold. They have found many reasons to rationalize their support, whether it's inflation, taxes, regulation, deficit, handling of the conflict in the Middle East, or the border situation. But the reality is you also have to weigh it against the fact that you have a stock market that's been hitting all-time highs. You have low unemployment. You have corporate profits soaring to new highs. And yet the people who should have benefited the most, or people who have benefited the most from this presidency, are the ones who seem most dissatisfied by it. And that's something that's being remarked on. You're not seeing a lot of these Democratic supporters come out loudly in favor of Joe Biden. You're certainly seeing a lot more of that noise from people supportive of Trump, wanting for, or looking for a flip in November.
Yeah, it's a good point. Relatively quiet when it comes to the Democratic side. Before I let you go, tell me about Bill Ackman. Of course, sources say that now he's leaning towards Donald Trump as well.
Right, and just after the verdict yesterday, he actually pointed out to a post from Republican Governor, Florida Governor Ron DeSantis, talking about how the political system has been co-opted, the judicial system has been co-opted in this case. He hasn't formally come out and said he'll back Trump. He's flirted with many other candidates throughout this process, but it does seem likely, as to where things stand, that he might be out there pretty soon saying he throws his weight behind Donald J. Trump.
All right, Sri, great reporting as always. Our thanks to Bloomberg's Sridhar Natarajan. Now coming up, the morning calls, and then later on in the hour, we're going to speak to David Leibowitz on the market impact of today's PCE numbers. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, yet ahead as the global trading day begins.
The Asia Trade premieres Monday, only on Bloomberg.
All right, it's time now for Morning Calls. Look at some of the analyst recommendations this morning. And first up, Seaport Global upgrading Wynn Resorts to buy, saying recent declines have created an attractive buying opportunity. Next up, we have Wolf Research upgrading Fifth Third to outperform, highlighting its superior deposit funding and also limited exposure to commercial real estate. And finally, we do have New Street initiating coverage on PayPal with a buy recommendation, expecting shares to benefit from its new checkout option called Fastlane. Meanwhile, you take a look at what markets are doing minutes before the opening bell. You can see a lift to futures right now. The S&P 500 currently higher, about 0.2% in the pre-market. The NASDAQ 100 kind of losing steam here. You can see we're still up by about 0.1%, but certainly coming in. You think about what we learned this morning when it comes to PCE, coming in at 2.7% on an annualized basis. That's not 2%. The Fed would certainly like to see that, but it is getting close. So a little bit of a sigh of relief in markets right now. The Russell 2000, your small caps, actually the outperformer right now. That index up about 0.4% in the pre-market. Of course, we will see if that can continue to hold in the cash session. Now coming up, JP Morgan's David Leibowitz joins us at the opening bell. We'll get his outlook for markets as the Fed goes quiet. That conversation coming up next. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is the countdown to the open. I'm Katie Greifeld. Moments away from the start of trading, you look at where we are on this Friday morning. The S&P 500 higher by about 0.1%. We are higher, but of course, those gains have been coming in. We are off session highs after that PCE reading this morning. Better than expected, right in line. That's good news for the Fed, but you take a look at the NASDAQ 100 right now, currently unchanged, giving back its early gains. You take a look at the bond market, though, it's holding its gains, still down about 4 basis points on the 10-year yield. We are back to 4.5%. The euro still at 108, and of course, crude right now currently about 0.2% higher. One stock to watch at the open: Nordstrom. The retailer fell short of expectations as its off-price chain Rack outperformed the rest of its stores. Abigail Doolittle has more.
Yeah, shares not responding well, Kitty. They are down sharply, and it's really an issue of profitability as well. A wider loss than expected. Sales actually beat by about 5%. They also grew by about 5% on a year-over-year basis, but there was a wider loss than expected, specifically a loss of $39 million. That translates to 24 cents per share, a loss of. Eric Nordstrom, CEO, said that roughly half of the profitability had to do with timing. Inventories apparently are higher. The CFO calling that a planning miss. Another piece of it, interestingly, had to do with an external theft in the company's transportation network, which they have apparently taken, quote unquote, swift action around. They did reiterate the full year guide. However, they said that shoppers remain cautious. Even so, they don't plan on discounting as much as they had in the past. There's a 21% short interest on this stock, and right now the stock is really about flat. So it's maintaining its 14% gain on the year and up about 37% over the last year, Katie.
All right, there you go. Nordstrom wiggling around, of course, as cash trading kicks off. Our thanks to Abigail Doolittle. Let's turn to AI now, because Dell's AI server sales failed to impress investors after high expectations overshadowed its first quarterly revenue gain in 2 years. Emily Griffeo is here with more.
Yeah, that's right, Katie. Dell poised for its biggest drop since March 2020, now down about 16% after, like you said, their strong AI server sales failed to impress investors. You look at revenue from that segment, and it more than doubled from the prior quarter, coming in at $1.7 billion. And the company said that it expects demand to continue throughout the year, but it simply wasn't enough after the stock had already run up 279% over the last year. You look at what Morgan Stanley said: while near-term expectations got ahead of themselves, they're confidently buying the dip. Not so much for Bloomberg Intelligence, our analysts saying that their AI server sales have come in strong, but Dell's profit less so. And again, that stock now down almost 18% at the open, Katie.
Yeah, really ugly end to the week for Dell. Our thanks to Emily Griffeo. Let's turn now to retail, because it's a different story at Ulta Beauty, reporting earnings per share that came in ahead of estimates and also laying out plans to boost sales and gain market share. Joining us now with more is Isabel Lee.
Hey, Katie, shares popped around 7% in the open, and now it pared back some of those gains, but still up around 3%. And the company reported first quarter EPS that came in ahead of estimates, and they did adjust their full year outlook lower, but analysts said that this is now more achievable. And this wasn't really a full surprise, because we have management in April already warning of cooling demand. But they do have concrete plans they laid out in place. This includes strengthening their exclusives with celebrities, enhancing their consumer digital experience, and leveraging their loyalty program. We have Jefferies, which is saying that the guidance now reflects continued competition in the industry, and we have Citi saying that, okay, yes, the guidance is indeed more achievable, but this uncertainty will continue to weigh on the multiple. The company's CFO did say that he expects the growth to accelerate in the second quarter, but overall, Ulta is doing well compared to its peers. We have Elf Rival already reporting also adjusted EPS that came in ahead of estimates, because an analyst said that this segment of the market is really what they call the affordable luxury. So maybe investors are playing on that. For now, shares are still up, but year to date, they're down 20%.
Yeah, certainly shoppers still eager to spend on beauty, especially among those younger consumers as well. Isabel Lee, thank you so much. Let's stick with retail now because Gap and Costco both beating estimates as consumers look for wallet-friendly prices. Simone Foxman has more. Hi, Simone.
Hi, Katie. Yeah, we're talking about one of the best and one of what has been the worst in the broader retail sector. Gap, this is part of a turnaround story by CEO Richard Dixon. He came in last August, and what we're seeing now is some of that turnaround delivering comp sales growth across every banner. Old Navy and Gap, the largest segments, saw comp store sales up 3% year on year. But you look at Athleta, that was supposed to be down close to 5%. In fact, comp sales rising 5%. That means for the fiscal year, the company able to raise its targets to see net sales up slightly from flat. Citi says the company is currently seems to be operationally, structurally stronger than it has in many years, and that's why we saw those price target rises. On the other hand, Costco, which has been one of these best-in-class performers, seeing price targets rise, but actually shares now down about 1% in early trading. Even though its earnings per share came ahead of estimate, it saw comp sales beats, including and excluding things like fuel and currency, seeing there a rise of 6.5%. Truist says consistently virtually unmatched in retail, but William Blair makes a suggestion here. These results just not enough against mounting expectations, and maybe that's why we're seeing some softness in those shares this morning, Katie.
If you go to 86th Street and 3rd Avenue, you have a Lululemon, and then you have an Athleta across the street, and you have to wonder if maybe Athleta is starting to eat Lululemon's lunch. Of course, we'll continue to follow that story, but tell me quickly about Costco. Costco has been so dominant this year, up 23% year to date, really benefiting from that trade down, but it seems like we're hitting a little bit of a limit there, Simone.
Yeah, I mean, the expectation is that this is just such a standout that will continue, especially as you see this pressured consumer. One real focus has been that Costco's not been able to raise its annual fee and has essentially sort of kept pushing out the date that it might be able to do that. There was some speculation about late 2024, 2025. There's some disagreement about analysts about exactly how important this is, just considering you're still seeing so many consumers show up there, and we saw that with the comp store sales beats in every geographic region. But of course, yeah, we've seen such a strong gains, 220% in the past year, so maybe that's where the softness is.
Yeah, just amazing there. You can see Costco now down about 1.5% in today's session. Our thanks to Simone Foxman. And joining us now is David Leibowitz. He is Global Market Strategist at JP Morgan Asset Management. And David, of course, the headline PCE number is getting a lot of attention this morning, but real personal spending in April actually unexpectedly declining about 0.1%. How much attention should we be paying to that?
Well, so I think to start on the inflation numbers, by the time we get to PCE, we have CPI, we have PPI. It's relatively straightforward to figure out what the deflator is going to look like. I think, to your point, the more surprising aspect of this morning's report was the decline in real consumer spending. And when we think about the data holistically that we've seen over the past couple of weeks, there's been some for the bulls and some for the bears. You know, we're kind of in this environment where a bit cooler economic data is being welcomed by the market. But if that cooler data continues, you do have to wonder, what is the limit of that bad news being good news, and when does the market begin to focus on the potential for perhaps a larger deceleration in growth than it was initially expecting?
Well, what's your personal threshold for that flip?
So when you think about it, we've been growing well above the underlying trend pace in the United States. We put trend growth right around 2%. And obviously over the past couple of quarters, 1Q excluded, but you can look at final domestic demand, growth has been well above trend. I think that as long as we're north of 2 and Atlanta Fed is tracking something north of 3, the market will be comfortable with a little bit cooler data. But I think the one thing that I would be keeping an eye on is what goes on in the labor market. You know, the reality here is that the labor market is tight, people have jobs, incomes are growing, and as we saw in the very low savings rate in this morning's personal income report, they're turning around and spending that income. And as long as that persists, this is an economy that can continue to move forward. But I think if we begin to see any material softening in the labor market, that could well be when bad news becomes bad news.
Well, we're going to get an update on the labor market in 1 week's time, of course, when we get those payrolls figures. But I want to bring this conversation to the equity market specifically, because this equity market, it loves a story. And for well over a year now, that story has been artificial intelligence. What other stories should investors be paying attention to right now?
So I think the big story for the second half of the year will be whether or not this broadening in earnings growth that a lot of people have been looking for actually ends up materializing. As we know, the profit story has been primarily about sectors like technology, communication services up until this point. You've begun to see some bright spots in the more cyclical parts of the economy, but what I worry about here is, a lot of people are looking for softer growth in the second half of the year. How is that going to square with the more cyclical parts of the economy seeing an acceleration? To me, that's a little bit of apples and oranges. And so from an investment perspective, we remain comfortable leaning into those growth names, leaning into those tech names where you're compounding cash flows at a very robust rate. And you also have a bit more of a defensive posture if growth does slow more than expected.
Well, just focusing on the index, there was a great story on the terminal earlier this week that if you take a look at S&P 500 net income margin, it's projected to surpass 13% in the second half of this year. That's according to analyst estimates. That would be a 15-year higher, just about. And I mean, when you think about those sorts of numbers and that earnings power, I mean, is that just a green light to pile in at the index level?
So when we think about the index level, what you're really piling into are the sectors and the industries that we were just discussing. Obviously, that upside risk to the margin being primarily driven by things like technology companies. I do still think that there's room for those names to run. When you look at the valuation of the Magnificent Six, it doesn't look particularly overextended. And so what we've seen over the past couple of quarters is that these companies are effectively growing into their multiples. As long as that continues, I think that the market can indeed continue to grind higher, but we did see in the most recent earnings season that even if you beat on earnings and revenues, if you didn't upgrade your guidance, the market punished that. And so we do need to be cognizant of growth expectations potentially becoming a bit too elevated relative to what these companies are able to deliver.
Well, this rally has certainly felt like a grind for the past few weeks. Let's take this conversation cross-asset right now, because you take a look at the 10-year Treasury yield, it's at 4.5%. That's pretty good, but then you take a look at T-bills yielding about 5%. How fierce is the competition with cash right now?
So we hear it from our clients. We see it in the data. People are very comfortable sitting at the short end until they have more clarity around the trajectory of inflation and what that means for the Federal Reserve. From a duration perspective, we've been maintaining our neutral posture. We don't necessarily want to be short duration because we do think that we're somewhere in the middle of the trading range. But getting long duration here without more confidence on inflation, without more confidence around the Fed, is increasingly difficult to do. And so we're playing the shorter end of the curve as well. That's our preferred space within the Treasury market. But cash is yielding north of 5%, as you put it. We have an inverted yield curve, and one of the things that we've been talking to clients about quite a bit is, yes, you can get north of 5% from cash here today, but if you think about the next 12 months, where do you think rates are going to be, higher or lower? I think that they'll likely be lower, meaning that there remains a significant amount of reinvestment risk simply from sitting in cash.
Well, let's talk specifically about credit, because I'm looking at your notes and you point out that you like quality in equities, but at the same time, you also like high yield bonds, which feels like a little bit of an oxymoron. Just walk me through that.
Sure. So I'd say the high yield view is probably our most out of consensus position. And effectively where that stems from is the idea that from a fundamental angle, the amount of upside that we see in equities is somewhat limited. We think 53.50 by the end of the year on the S&P is a reasonable expectation. When we look at credit and we look at all-in yields on high yield being north of 7%, frankly, we like those assets for the total return and we like them for the carry. Now, to your point about high quality equity and also liking high yield, I'd push back a little bit on that because the high yield market is much cleaner and much higher quality than it was historically. I recognize that there's still junk bonds, but you look at a lot of these companies, they have public equity behind them, so you're sitting higher in the capital stack than you would have been 15 or 20 years ago. And again, we look at leverage ratios, we look at interest coverage ratios. There has been a bit of degradation as of late, but still sitting at levels that make us very comfortable holding high yield bonds within the context of a multi-asset portfolio.
And David, just quickly before I let you go, are you more comfortable with credit risk or duration risk at this point?
we'd be more comfortable taking credit risk. I think at the end of the day, again, until we have more clarity on the direction of rates, until we have more clarity on the direction of inflation, we're going to maintain a relatively neutral posture on duration. And yeah, I think the best proxy for thinking about when to really begin to lean into duration is simply looking at interest rate volatility. It's come down quite nicely over the past couple of weeks, but still elevated relative to history. And what that says to me is that when it comes to the outlook for rates, there's still a relatively wide distribution of outcomes. And so we'd like to see volatility come down. We'd like to see that distribution of outcomes begin to narrow before leaning into duration, either from the long side or the other.
Well, David, that's a nice place to end it. Have a great weekend. Our thanks, of course, to David Leibowitz of JP Morgan Asset Management. Now coming up, Dell's earnings beat fails to impress investors with shares falling the most since March 2020. Details next. This is Bloomberg.
The names that move markets are on Bloomberg.
With all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. Look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience. But are you hopeful that I'm always hopeful. Come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
New PCs will be AI PCs, right? And the reason is that anything that you're doing that has an edit prompt is going to be sped up because every software developer in the world is figuring out how to use all this new power in the GPUs and the NPUs.
And that was Dell Technologies CEO Michael Dell speaking to Bloomberg TV earlier this month about how AI PCs will be standard by next year. Meanwhile, Dell reporting its first revenue increase since 2022, but wasn't enough to impress investors. Dell, of course, facing lofty expectations for its AI server business, with the stock soaring over 120% so far this year. Woo Jin Ho of Bloomberg Intelligence joins us now with details from Princeton. And you take a look at the stock really falling out of bed this morning. Did something actually go wrong, or is this just a case of too high expectations?
Yeah, hey, Katie, thanks for having me on. Look, I do think it's fairly lofty expectations. If you think about the valuation for Dell, it was running around 21 times forward earnings. Typical hardware valuations are roughly around 9 to 10 times on a good day. So you had an AI premium of 100% just on the PE alone. So, you know, everyone was riding the AI train, and unfortunately, you know, Dell fell short of it.
They fell short, and they're certainly falling today, currently down about 19%. That is the biggest intraday drop on record, it looks like. Is that an overreaction?
Well, we can't talk about stock valuations. I will tell you, in terms of the sell-off, I think there was a number that was in mind in terms of the backlog. That there was a $3.8 billion backlog number, and I think people were looking for something north of that to think that the AI momentum is going to be strong for Dell.
Yeah, $3.8 billion backlog. It's just not good enough in this environment. Let's talk a little bit about the PC business when it comes to Dell. Of course, we heard from HP earlier. It seems like those results provided some optimism about the PC market. What did we learn from Dell?
Yeah, you know, really interesting, because the commercial PC market is turning out to be a lot stronger than I had anticipated. HPE, as you said, showed growth for the first time in the commercial PC market in several quarters. Dell also showed growth in the commercial PC market as well. So the commercial PC upgrade cycle is turning out to be quite a bit stronger than one had hoped. And to be fair, there is a Windows 11 upgrade cycle that's going to be a tailwind for the leading commercial PC makers, Dell and HPQ. It seems as if that momentum is turning out to be a bit stronger than we had thought.
What does the competitive landscape look like there when it comes to the PC market? Of course, we have Dell, we have HPQ, as you point out. Who is in pole position?
Yeah, so from a volume perspective, HPQ is the market leader, along with Lenovo and Dell. Those three companies account for about 75% of the commercial PC market from a unit perspective. If we think about it from a revenue perspective, Dell has about 80% of their PC sales indexed to commercial PCs. So they're very over-indexed to commercial PCs. HPQ is about 67%. And look, if the corporates are coming back to buy PCs sooner than later, then Dell's going to benefit from that.
All right, Woo Jin Ho of Bloomberg Intelligence breaking down those Dell results. Of course, the stock breaking down right now, currently lower by about 19%. Let's broaden out right now and look at some sector price action. We're going to do that with Bloomberg's Abigail Doolittle.
Well, we're looking at a small gain for the S&P 500, Katie, the first in 3 days if it holds. And we do have more sectors higher than not, so it is broadly supported. Energy, the best sector, up about 0.9%. Healthcare, real estate, utilities. To the downside, we have consumer discretionary, but down just 0.25%. Consumer staples and communication services also down just slightly. Let's take a look at the month, though, because a big month here for the S&P 500. Lots of sectors higher. In fact, many of these sectors having their best month of the year. That is true for technology as well as utilities. So the bulls are out in the month of May after a little bit of a dip into April, but here we have some real strength for broadly across sectors, Katie.
The bulls are out. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's time now for the Trading Diary, what you need to be watching. Today we have the Baker Hughes U.S. rig count. That's coming up at about 1 p.m. today. Plus, Fed speak later today from Atlanta Fed President Raphael Bostic. Remember, we are heading to that blackout period. We're not there yet. Looking forward to next week. On Monday, we got U.S. manufacturing data and construction spending. And then on Tuesday, the U.S. JOLTS numbers and factory orders. Of course, that is all pushing ahead to that U.S. jobs report coming up in just 1 week's time next Friday. An important look at the U.S. labor market. But let's take a look at markets right now. Of course, on this Friday, you can see, if you take a look, it's still small caps in the lead. Of course, the Russell 2000 currently up about 0.6%. Cannot say the same for big tech, really taking a bit of a dive here. The NASDAQ 100 currently lower by about 0.3%, giving up those pre-market gains. Meanwhile, the S&P 500 pretty much back to flat. You could say that's 0.1% higher if you're optimistic, but I think we can call that flat. The S&P 500 currently lower by about 1% for the week. That was the countdown to the open. I'm Katie Greifeld, and this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live here on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. Alex Steele, Paul Sweeney. We are here. We're focusing on companies, stocks, bonds, the markets. We lean heavily on our good friends at Bloomberg Intelligence. Close to 500 investment professionals there covering 2,000 companies, 130 industries on a global scale. We'll be tapping into their expertise over the next couple hours. Kicking off this hour, we're going to check in with David Gura. He is in Midtown Manhattan at Trump Tower getting ready for President Trump, who is scheduled at 11 a.m. to deliver some comments. So we'll check in with David Gura there. Elias Sabo, CEO of Compass Diversified, is also going to join us in this hour. We're going to talk about the consumer, maybe consumer M&A as well. Scott Reckler, CEO and chairman of RXR, to discuss the latest in commercial real estate. We know offices are really under pressure. How about other parts of the commercial real estate space? We'll do all that in the first hour here and continue to check on these markets. Let's kick it all off today with Mr. John Tucker, Bloomberg Business Week.
All right, Alex and Paul. Happy Friday, by the way. Major stock averages mixed as we close out the trading week. Consumer discretionary communication services proving to be the biggest drags right now. The S&P 500, the Fed's favorite inflation gauge, taking a step in the right direction. Underlying U.S. inflation moderating for the month of April. So how's it being viewed by policymakers at the Federal Reserve? We put that question to Margie Patel at Allspring Global Investments.
Well, probably a sense of relief that they don't need to do anything. And I think what we're going to see from the Fed is more just watchful waiting and do nothing and hope that inflation more or less is around this level or maybe ticks a little lower.
Dell Technologies' first revenue increase since 2022. Not enough to impress investors. They had pretty high expectations for the AI server business for the company. Dell right now 18% lower. Then you have shares of the Gap getting a lift. They reported first quarter total comp sales topping expectations. The Gap up over 20% right now. S&P 500 dead flat, 52.35 in the index. The Dow Jones Industrial Average up 45 points. And the NASDAQ 100 right now, 81 points lower. It's time for a reset as we approach June. S&P 500 for the year up 9.75%. The NASDAQ up over 11% for the year to date. The Dow Jones Industrial Average, up 1%. Anyway, we check the markets for you all day long, right here on Bloomberg Radio. And I should say, we're brought to you by IBKR, financial advisors switching to interactive brokers for lowest cost, global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests at ibkr.com/RIA. Alex and Paul.
Hello, John Tucker. How are you? Happy Friday, everybody. This is exciting. We made it.
It's exciting that it's Friday, isn't
it? It is. It really is.
Summer.
In the summer.
In this neck of the woods, it's beautiful out, too.
It is. I'm Alex Steele, alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We cover all the news. I gotta say, I mean, I like John Tucker saying, for the markets? Because it's really just, buying bonds. That's pretty much it.
That's fine. Buying bonds is, again, you get the two-year Treasury, Alex, at 4.9% here on a two-year Treasury. Maybe you want to take a little bit of credit risk. You can goose that a little bit, but that's fine for a lot of folks.
Totally fine. You don't want to take the equity risk. Okay, you're just sitting there. Maybe it's buy bonds and go away. All right, let's continue that story that we're watching, and that is, of course, Trump. Former President Trump will be speaking later on in the 11 a.m. hour. David Gura is correspondent for Bloomberg and host of the Big Take podcast, and he joins us remote from the Trump Tower in New York City. David, what is the mood there?
Well, it's gotten more crowded over the last hour with kind of looky-loos walking down Fifth Avenue, wanting to see what's going on. There's a lot of media here as well, and there was kind of a funny or strange moment just a few minutes ago when two limousines pulled up. Looked like they had presidential seals on them. On closer inspection, you could see, in fact, they were doctored, and the American flags on the front were turned upside down in keeping with the news of recent weeks. And then somebody who's a Trump impersonator got out, and it was just enough to kind of convince everybody that it was, in fact, the former president here to greet folks who had gathered in front of Trump Tower, but in fact, just an impersonator. So we're about an hour away from when Donald Trump is scheduled to speak in the atrium of Trump Tower. And we're looking for two things. We're looking to see what his temperament is in light of the verdict that was rendered yesterday by that jury in Lower Manhattan, but also what he has to say about the path forward. He did talk frequently throughout that trial, coming down to the lobby of the courthouse, decrying the proceedings, criticizing the judge. I expect we'll hear some more of that, variation on that theme today. But then also sort of how he intends to move from the legal arena to the political one. Obviously, there's still a lot pulling him in that legal arena, those three other cases that he's facing. And then the appeals process and the sentencing, which the judge yesterday scheduled for July the 11th, guys.
David, is former President Trump still under the gag order, and will that impact what he says today?
This is a great question and an open question. I don't know the answer to that, and I've seen various people weigh in on that in various different ways. But I will say he has tested that gag order numerous times. He tested it over the course of the trial. 9 or 10 times he was fined by the court for criticizing the jury in the proceedings, the judge and his family. And the judge very sternly said to him in the middle of that trial that if these fines weren't enough to keep him from overstepping his bounds, the judge would be content to throw him into jail. So a very serious threat, and one that a lot of observers thought really resonated with the former president. That said, in his remarks yesterday after the verdict, he again went after the judge, again went after the proceedings. So we'll see to the degree to which that's weighing on him, and that uncertainty that I mentioned about that gag order is shaping what he does and doesn't say.
All right, David, we really appreciate it. David Gura, correspondent for Bloomberg and the host of the Big Take podcast, waiting, of course, for former President Trump to speak in the 11 o'clock hour. Let's get back to the markets. Is what John Tucker said, and I'm stealing it and I'm using it all day. But we do have some individual stocks that are making some big moves, some surprising. Norma Linda joins us for more. Dell Technologies, this is what I do not understand. The numbers were really good, and the stock gets punished.
I feel like we've been hearing this story so much lately. I mean, we're really seeing some high expectations here from Wall Street here for Dell Technologies. We're seeing shares down as much as 19%. Now, this is the stock's worst intraday on record. And this is after its results from its AI server business, which we know AI has really been in focus more broadly. It failed to impress investors. Its first revenue, it had its first revenue increase since 2022, but investors were really looking for more. Analysts say that its revenue increase did come at the cost of weaker profit margins. And we do have to note that the stock has more than tripled over the past 12 months. So this could be a bit of profit taking. That's something to still be discussed. But the main takeaway here is that its revenue beat was largely overshadowed by its AI server backlog, missing expectations here.
I mean, the stock was trading. I mean, Dell is a real company, real stock, real market cap, real research coverage, depth of trading. It's not a meme stock, but it was kind of trading like one almost. Again, you mentioned that more than 100% move. Dell doesn't trade like that. So, I mean, I guess today is just a little bit of selling the rumor. I don't know.
I don't know. We're going to have to wait and see if there's more that comes through. But, I mean, it does seem like you just can't impress investors sometimes. And this clearly seems to be the case here when we look at the AI server business.
But you can very much impress Gap.
You can.
This amazed me, too.
John Tucker, big
I
Gap
gotta say,
customer.
he's a big Gap. One of those 2 pairs of shoes he has definitely comes from Gap. They delivered. They really delivered these numbers.
Right. And I mean, this really is a turnaround for the company. We're seeing shares up as much as 21%. Now, this is the best intraday since November. And Gap could be headed for a turnaround, especially with Wall Street eating up its new profit-making strategy. So we've really been looking at Richard Dixon. He's a new CEO who's known for reviving Mattel's Barbie franchise. And now he's really focusing on embracing celebrity marketing when it comes to Gap. And that seems to really be paying off. The company actually paired up with an independent label and hired a fashion designer, Zach Posen, as a creative director for its Old Navy stores. So it's worked with people like Anne Hathaway. She worked the red carpet in their brand.
That's right, she did. It was good for the Met Gala, right?
Yes, it was actually, I think this was in Rome, if I'm not mistaken.
Oh, you're right.
But yes, so we also have Tyla. She's a South African musician. She's also done some ad campaigns. So we're really seeing a lot of generation around this. And so it did beat on its first quarter total comparable sales, but now the company is also ramping up its sales and margin projections for the full year. So quite a turnaround here, maybe on the works.
All right. And just real quick, are we still investing in our faces?
We're definitely investing in our face.
Okay, and that goes to
Does Ulta think we're still investing in our face?
Well, we do have shares higher, up as much as 9.2%. Now, this is the biggest one-day gain this year. So this beauty brand delivered the first quarter earnings per share that came in ahead of estimates. It did lower its outlook for the year, and analysts are actually noting that it did think that this outlook was more achievable now than before. We have Piper Sandler saying that the recent pullback in shares and estimate reset makes them feel more increasingly comfortable buying at these levels. So a bit of a pop here.
All right, thank you so much. We appreciate it, Norma Linda, joining us on some of the big movers of the day. And along those points, we want to go to Elias Sabo. So I've known him for a long time. He's CEO of Compass Diversified. He's joining us from California. And he has a portfolio of companies that he invests in. A lot of them are retail, and a lot of them are in other sectors. So we can kind of get to all of them. And he's a great person to talk about retail, but also inflation. That PCE data kind of right in line with where we were expecting it. So nothing moving the needle either way when it comes to the Fed. Elias, it's great to see you again. It's been a while. Let's just start with retail for a second. What is your read on the consumer right now?
Yeah, good morning, Alex. Nice to see you as well. You know, we're seeing the consumer, and I hate to continue to say the same thing, but we're seeing this bifurcation where the more affluent consumer continues to spend if there's products that they want or services that they like, and the more inflation impacted consumer on the lower end is having to make real choices. And so that trend continues. But what I would say we've seen, kind of in the more recent few months is just a steady weakening of kind of activity. Our industrial business has seen a little bit of a step down. The consumer business is growing quite rapidly, but is starting to slow a little bit from where it was. So I think the consumer is starting to weaken, and we saw that with the, retail sales data, which fell on a real basis today.
So, Elias, a lot of folks are saying when you look at the consumer out there, there's at least two types of consumers out there. The ones that are maybe asset rich and they're benefiting from the rise in the stock market, the bond market, real estate, and those that aren't, that are really feeling the brunt of inflation. Do you see that in kind of your companies that you invest in?
Yeah, Paul, we, in the companies we invest in mostly skew towards the more affluent consumer. And so those are more balance sheet rich customers that we have. And we've seen just really robust shopping patterns continue with that consumer subset. We have a small portion of our business that is more at the lower end and goes through the mass market. And for the last couple of years, that business has really been under pressure. And we're seeing that consumer, have to make choices. And so, yeah, there is a real bifurcation. And right now, being at the affluent end is where the market is holding up well.
Elias, what's the inflation and the supply chain issue when it comes to retail? Where is it now versus, say, where it was a year ago?
Yeah, a year ago, Alex, our inflation was principally coming from multiple places, but principally from labor. And there was a terrible imbalance between the demand for labor and the supply of labor. Fast forward to today, we're actually starting to see that reverse. In fact, I just came out of all of our board meetings about 3 weeks ago with our 10 subsidiary companies. Nobody's complaining about labor problems anymore. We're seeing wage pressures, kind of elevated a little bit, maybe up 50 basis points from historical norms. If you went back a year ago, that was 200 to 300 basis points. So, we're seeing those labor pressures really subside right now. Where there are some pressures on inflation gets more to distribution costs, so warehousing, transportation. But in general, Alex, if there's one thing I would say, our view on the street is that inflation is probably falling faster than what we even saw in today's report. And I say that because we have customers that are asking us now for price concessions. We're doing the same with our suppliers, and we're seeing just easing of pressures across the board. So I think the trend in inflation is going to be down and down pretty significantly as the year unfolds.
So, Elias, I know your firm, your Compass Diversified, focuses on 3 verticals: branded consumer, niche industrial, and healthcare. Where are you seeing some of the best opportunities these days?
Yeah, I would say the best opportunities, Paul, are in consumer. You know, what we've seen is the more defensive sectors, especially healthcare and where we invest is critical outsourced services. Those have really attracted a lot of demand. And so there's a lot of trades that are happening there, but they're at very elevated prices. In the consumer business inside, what we're seeing is the choppiness of consumer earnings coming out of the pandemic has led a lot of financing partners to exit that part of the market. And we're not seeing private equity be as active. So we're seeing good deals come in consumer. We closed on a great company called The Honey Pot in January of this year. And so this is a perfect opportunity in market for us because competition is, pretty much exited the consumer space right now, or it's, very weak compared to where it's been. And that means pricing comes down as supply of deals comes back into the market.
What about industrials, niche industrials? What does that mean for Elias Sabo right now?
Yeah, mostly, Alex, we're working in the industrial tech side. So, think of things that are helping with green energy and, other technology-enabled industrial processes. The industrial business, pricing is actually quite high there too, believe it or not, on the M&A side. And we're seeing some weakening in some of the order books. So it's a little bit confounding to us how pricing could be up as high as it is with the economy showing some weakness, and that directly impacts industrial. But, I think where we are, which is more in the industrial tech side, we think that stays in the United States, and that is going to be something that grows, especially with government policy changing. And, a lot of the advent of AI in the computing business, I think that's going to drive more manufacturing here, and we're going to be able to do it pretty efficiently, especially in the higher tech industrial space.
Elias, just real quickly, I'd love to get your perspective here. What's the financing market, the capital markets like for a company like yours looking to make acquisition? Can you finance your deals here? Obviously, rising interest rates makes it a little bit tougher.
Yeah, so Paul, we're a little bit different in that we are a publicly traded company, and when we acquire, we finance at the holding company, not at our subsidiary levels. And so the markets have been, fairly open to us and have been, for the last couple of years. We have bonds that publicly trade, and the pricing on those bonds have come down. They're still up from where we issued in 2021, but we issued sort of at the peak of the market. So the capital markets remain very much open for us. We've been able to raise capital both in the debt markets and on the equity markets to fund our acquisition programs. I would say in terms of the M&A markets where you have single asset LBO financing, we're starting to see that market come back as well, but it is coming back with higher pricing. And so it creates a competitive advantage for us in our financing structure, but we are seeing financing come back into the middle market M&A space.
Elias, thanks a lot. We really appreciate it. I love that you can hit on all the different industries and have a great window into the capital markets. Elias Sabo, CEO of Compass Diversified. That ticker on the NYSE is CODI, joining us from California. Interesting, right? I mean, particularly with the industrials, like the order books are a little soft, but pricing is still strong, like some dislocations. But interesting with the inflation read that we're actually going to see inflation continue to come down. Could the Fed be right?
Yeah, maybe the Fed does actually have a soft landing.
I mean, that would be something. All right, coming up, we're going to talk to Scott Reckler. He's CEO and chairman of RXR on commercial real estate.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. Stock's pretty much drifting as we close out the trading week. S&P 500 on track for the first losing week in the last 6. Federal Reserve's preferred measure of inflation moderating for the month of April. Core PCE posting the smallest increase of the year, rising just 0.2%. This is the data we got this morning. It offers Fed officials some solace that a rate cut is the way to go. Some of the individual shares on the move. Gap right now up close to 22%, one of the market's biggest gains after delivering stronger profit and revenue for the latest quarter than what was expected. Parent company of Old Navy and Banana Republic reporting growth across all its brands. And then the story about Dell, down 21% right now, matching analyst expectations in their report for profit in the latest quarter, but the street wanted even more on the AI front. Right now, the S&P 500, 12 points lower. That's down 0.25%. We're at 52.23 on the index. The Dow Jones Industrial Average up 42 points, and the Nasdaq 100 right now 140 points lower. That is down 0.75%. As far as yields, the 2-year, the policy reactive 2-year, 5 basis points lower after the economic report this morning. That's at 487. The 10-year is down 5 basis points, and that is at 449. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Bull and Alex.
Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance through our lens of our amazing analysts. They cover 2,000 companies and 130 industries worldwide. We also tackle the big topics in the world that we all have really big questions on. And one of them is commercial real estate. We're all waiting for that shoe to drop. Some shoes have dropped. We get the news over the last week that S-REIT, Barry Sternlicht's REIT, is going to pause redemptions, very similar to what B-REIT did a few years ago. And where are we in that cycle, and why are we seeing that now? Well, joining us for his insight, which may be a little counterintuitive, is Scott Reckler. He is CEO and chairman of RXR. Commercial real estate in New York. How you doing, Scott?
I'm doing well. Thanks for having me.
Thanks for coming in. We really appreciate it. When I hear a headline that S-REIT is halting redemptions, that makes me think, oh my goodness, CRE is going to be toast. What's happening? What do you see?
Yeah, so I think, and Barry's been very vocal about this for a while, right, which is that there's been a day of reckoning coming, and it's somewhat been delayed last year as the Federal Reserve got a little bit more dovish in their tone, that people thought maybe interest rates were coming down. But I think the industry has now gone through its 5 stages of grief, and they've gone past the denial and are now at acceptance. And so a recognition that rates aren't going to come down, and so it's not going to be some saving grace. And so they have to deal with these challenges. So now the banks, the institutions are busy, taking the appropriate marks, taking the appropriate reserves. And now we're going to have to start going through the process. It's a big problem, right? There's $1 trillion of debt that's coming due this year, $2 trillion over the next 3 years, and most of this debt has been financed at interest rates that are not normal interest rates, right? They're interest rates that were much lower for the last 10 to 15 years that aren't going to come back. Now we're going to have more normal rates. So we have to go through a re-equitization. Means that there's going to be pain on the equity side, pain on the debt side. You saw today there's an announcement about U.S. pensions having to take more write-offs on the commercial real estate. We've seen more banks having issues. I think that's going to happen as well. So we're just in the beginning now of facing this challenge, and it's going to be something that's going to work its way through this year and into next year.
All right, so let's just say I've got a building in Midtown, wherever. I'm part of that $2.2 trillion that's coming. I go to my bank. The interest rate's much, much higher. The value of my property is 30, 40, 50% lower. I don't know, something along that magnitude. You only loan to value of 50%. Something's got to give there, right?
Exactly, that's right. So, I mean, I think, and again, this is different than like the 2008 crisis, right? When 2008 came, there was this injection of capital that really sort of lifted all values, right? In this case, we have a structural period between the interest rates, and then some types of properties aren't going to be competitive. So you referenced an office building today, right? And then that commentary. Office not only has the revaluation because of interest rates, but people use office buildings differently, and some buildings are going to be competitively obsolete. So you have to pick the spots correctly, and then you have to face that reality. So the bank has to adjust its loan. The equity has to write off the equity and inject new equity, and you have to pick which buildings are going to be successful in this post-pandemic world. I think, the other piece of this is multifamily, which I think to me is more of the Achilles heel for the broader regional bank, because there's a heavy concentration of multifamily in the regional banks around the United States. They have, something like 50 to 60% of their book of business is loans. And those loans, even if just from an interest rate, even if credit is good, is underwater today, right? But now you also have new supply coming into the market. So there's going to be a couple of years of headwinds on that multifamily market that I think is going to put a lot of pressure on these regional banks going forward.
So when there is pressure, are you a buyer? Are you a seller? What do you do?
Yeah, listen, I think these could be a generational moment of time to be a buyer, right? And so we're active in the market, but you need to be very selective, right? It's not just about having the capital. You have to have the capabilities to choose which of the properties that are going to be successful. You need to bring down the basis, so you're not going to do this and think values are going to come back. You're not doing this on a bet that interest rates are just going to fall and everyone's going to do well. So you have to find a way, how are you going to create value? And you really can't be necessarily try to time the top or the bottom, right? So we had a company that we sold in January of 2007, and we didn't know it was the top, but it felt frothy, right? So we sold it. We came back in the market of August of 2009. We didn't know where we were in the cycle. It just felt like the right time to enter. So moments like this is where you want to start entering before the all clear signal is sounded, but you have to be very selective, but know that there's a lot more trouble to come that's going to create more distress in the system.
Scott, do we have a housing shortage in this country? And if so, how did we get there?
Yeah, we definitely have a housing shortage in this country, and it began to transpire after the last financial crisis, right? You ended up being in a situation where, the ability to build new housing became more challenging. People were more conservative. So there's, estimates of about 6 million units of shortages of housing in this country. And now, because of what the low rates during the pandemic, you've had this incredible amount of people buying homes, financing along. So existing home sales aren't trading. So we have this weird anomaly. While interest rates are up, housing prices have stayed strong, and the market hasn't really weakened in that regard. And so, it's going to exacerbate the problem, right? Because now if you have less construction, as we get to 2026, you're going to have less housing today than you have the demand for housing.
So when you're getting the feeling that, there's distress, it's time to buy, even though there'll be more distress later, how do you get that feeling? Like, is there a screen that you look through to make sure, like, okay, not that property, but yes, this property, even if they're like right next to each other or something? Like, how does your brain work with that, Scott?
Yeah, no, I think you got to be very concrete and have, then screen's a good word, right? We have formulas. So like for office as an example, we created something called Project Kodak, and we said some buildings are going to be digital, that are going to be successful in the post-pandemic world, and some are going to be film, and they're not going to be successful. And we said, okay, we want to invest in digital, and we put the whole set of criteria as to what is digital. And those are the properties that are digital.
What is digital?
So digital are buildings like this Bloomberg building, right? Which are, have places where people can collaborate. They want to come to work because you can engage with people. They're in good communities. They're easy access from public transportation. And so that is something that ultimately will be successful of attracting people. And so you need digital buildings, but they still may have broken capital structures. So our objective on investing is identify the digital buildings with the broken capital structures, invest in them, fix the broken capital structures, and when you do that, you see the leasing. Like last year, we leased 2 million square feet of space. This year, so far, we have 1.5 million square feet of leases out, right? So if you have the right building with the right capital structure, there's a lot of tenants that want to be there.
I keep just stuck in my head from maybe 18 months ago, a Bloomberg News article came out and looked at 3rd Avenue, Manhattan, between right where we are today, 58th Street and Grand Central down to 42nd Street. Virtually, you could write that whole part of Manhattan off, and that shocked me because you've got some iconic buildings there the lipstick building, just for example, those aren't, most of them are not A buildings. I've learned that term, A plus. Maybe they're B and C. What do you do with something like that?
Right, so this is really where you need to start thinking about adaptive reuse, right? If a building is going to be competitively obsolete and it's an office building, what are the alternative uses? And so we, as an example, we're in the process of converting 5 office buildings to multifamily.
Really?
And
but I heard that's hard.
It's right. Some don't work, right? Okay. So you need to find ones where you have the right type of footprint in the right location, so you can efficiently, adapt those floors. And so that's something that is important. But there's 2 caveats to that, right? One is the value that you need to be investing in that building needs to be almost the equivalent of land value. So you need to have the capitulation of value coming down to that in that mix there. And then the second, you need incentives. And so we're fortunate in New York, the state just passed a tax incentive that about 90% of the tax that you normally would pay is deferred for 35 years. You don't pay it for 35 years. So if you go through that process. So public policy can help get that done. And that's something that I think is going to help accelerate this transition.
That's fascinating stuff. I mean, real estate's always a fascinating business, but especially now. I don't know how these guys are doing it.
Seriously, I love that Kodak one. That's
I get that.
We're going to reuse that.
We're going to use that. We'll give you full attribution. But yeah, Scott Reckler, he's CEO and chairman of RXR. We're talking real estate here. Lots of opportunities. I'm starting to hear more and more people come in here and say, selectively, we think there's some time and some opportunities to make some acquisitions. So we appreciate checking in with Scott. S&P 500 off 0.4%. With our news in New York City.
Thank you very much, Paul, Alex, John. In about a half an hour, former President Donald Trump will comment before reporters in front of Trump Tower in Manhattan. Trump will talk about the guilty verdicts in the first criminal trial of a former U.S. president in the nation's history. Bloomberg will carry it live. After 2 days of deliberations, a jury of 12 New Yorkers found Trump guilty of all 34 counts in his hush money trial. Yesterday, Trump played down the verdicts. Bloomberg's Ed Baxter has the story.
Trump says the real jury is voters.
The real verdict is going to be November 5th by the people.
And in surveys conducted prior to the verdicts, he may pay a price. A May 23rd Marquette Law School poll of registered voters found that a guilty verdict would produce a 4-point Biden lead nationally, head-to-head. If there had been a not guilty verdict, Trump would have held a 6-point lead. Politically, it may depend on how the Biden administration tries to keep the convictions fresh in voters' minds. Ed Baxter, Bloomberg Radio.
Trump says he plans to appeal. Many Republicans say Trump should never have been charged. GOP Senator Tom Cotton of Arkansas.
This was a sham-rigged political show trial from the very beginning. You have a prosecutor who campaigned on the promise to get Trump on anything. You have a judge who's literally a Joe Biden donor who rigged the rulings at every turn to include, for instance, a gag order while the president was on the campaign trail.
Senator Cotton spoke with CBS. Most Democrats say the verdict needs to be respected. Democratic Congressman Adam Schiff of California.
One of the factors the judge is going to consider is, does the defendant accept responsibility? Does the defendant show remorse? Is the defendant willing to pay restitution? And it's quite clear that that is simply not the case with him.
Schiff was the lead prosecutor in Trump's first impeachment trial. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the newsroom with this Bloomberg Business Flash. Cool down in the Fed's preferred inflation gauge. Got that this morning, and that's reinforcing bets policymakers are going to have room to cut rates this year. Yields are lower, and stocks right now, they are mixed to little change, the major averages. S&P 500 is lower while heading toward its best month since February. Meantime, Jeffrey Yu at Bank of New York Mellon says despite political turmoil out there, investors will stay focused on what is important to them.
Take one step at a time, follow the data, follow the news and event risk, and then just, go from there. For the time being, it really is the Fed that is in the driving seat for markets.
Right now, the S&P 500, 20 points lower. That's down 0.4% at 52.15. Dow Jones Industrial Average up 28 points. And the NASDAQ 100 right now, 207 points lower. That is down 1.1%. Stocks on the move. The individual shares, Gap up 21%, let's call it 22%, and Dell 20% lower. As for yields, 2-year is 5 basis points lower. That's at 487. The 10-year yield right now, 5 basis points lower. That is at 449. And in what's considered a pretty bold move, Bill Ackman planning to take public his investment firm, Pershing Square, could happen as soon as next year. And as a first step, he's selling a stake in Pershing Square. So that would value the firm at about $10.5 billion. Seems maybe a little rich compared to the valuations of other asset managers in the same category. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So you just have to head over to youtube.com and search Bloomberg Podcast, and that's where you'll find the video feed. Of course, the news of the last 24 hours, former President Trump found guilty in the hush money case. We've been talking about it all day. We will bring you, former President Trump is scheduled to speak at 11 a.m. Wall Street time. We will bring that to you when he does speak. The question now, I think for a lot of folks, is now what? What happens? And for that, we're going to check in with Robert Mintz, former federal prosecutor. He's now a partner at the firm McCarter & English. He joins us from beautiful Princeton, New Jersey, home of Hoagie Haven, via Zoom. So anyway, best hoagie shop in the world, Hoagie Haven. Just saying, laying it out there for you.
I've never had it.
Well, we'll go. We'll do a remote there. Robert, thanks so much for joining us here. I guess the question on everybody's mind here, Robert, is given these convictions, 34 felony counts, will former President Mr. Trump, will he go to jail at all?
Well, that really is the big question here, and that's a decision that is going to be made solely by the trial judge. The way it works in New York and everywhere else in a criminal case, the jury is the finder of fact. They ultimately determine guilt or innocence, and we know in this case they convicted the former president on all 34 counts. Now the question of sentencing is entirely up to the judge, and it could be anywhere from a probationary sentence to up to 4 years in prison or other possible terms and conditions, home confinement. There could be a lot of different things the judge could do here, but it's a very weighty decision and a very difficult decision for this judge to decide what is the right thing to do here, given the gravity of this case, given who the defendant is here, and given the fact that the defendant in this case, I think we're not going to see former President Trump coming in on sentencing day and expressing remorse for what he did. Those are all factors that the judge will consider in fashioning his sentence.
How does a judge come up with a sentence? How does that work?
Well, typically what a judge does is he or she will look at the way similarly situated defendants have been treated in the past. So people who have been convicted of the same types of offenses, do they typically go to jail? If so, for how long? In this kind of case, it's a record-keeping case. Usually for a first offender, there will not be jail time, but there's also other factors that the court will consider, the age of the defendant, as I mentioned earlier, too, whether the defendant expresses remorse, acknowledges that they committed a crime, that they've done something wrong. And I think the judge will also take into account, at least in some manner, the fact that there are other pending criminal cases out there, and also the way in which former President Trump conducted himself during the trial. As you remember, the judge imposed a gag order. He was found in contempt several times for making statements that the judge found to have crossed the line. All of that may factor into this, and the judge will have to decide, does he or does he not send former President Trump to jail, and if so, for how long?
That's kind of where I wanted to go, Robert. We're waiting comments from former President Trump at 11 a.m. from Trump Tower. So my question is he still subject to the gag rule? Because it doesn't appear that he's going to hold back on any commentary about the judge or the trial itself.
Well, that's a great question, and I think it's a little bit unclear, but generally probably not, because the gag order was really imposed so that former President Trump would not make comments that might have affected witnesses or might have affected jurors. None of that really is relevant at this point. The case is over. There's been a conviction. So I think we're going to see former President Trump speak freely. I don't think we're going to see the judge in any way react to those comments unless it gets very personal with court personnel or with the judge. But otherwise, I think the judge is just going to let it go. But he will be watching, and I do think those issues and statements that are made by former President Trump may ultimately factor into his decision about whether or not to send former President Trump to jail, and if so, for how long.
If this trial had been held in any other state but, say, California or New York, would it have gone any differently, or would it be reasonable to have expected this outcome in the majority of jurors and trials?
You know, that's a great question, and obviously impossible to answer. I mean, I do think we saw a fairly diverse jury in the sense that you had people from various backgrounds socioeconomically, people who were from different parts of the city. So there was some balance to that, and you do have to remember that both the prosecution and the defense played a role in picking this jury. They were able to exercise what's called peremptory challenges, which means to strike jurors who they did not want on the jury for whatever reason. And so they both jointly ended up picking this jury. But you're correct in that there is a jury pool, a limited number of people that you'd find in Manhattan. And the question is, would they be any different than a jury pool in some other state? The answer is we really don't know. The reality is that it probably is different from state to state, but that happens in every criminal case across the country. No matter where it's tried, whether you're in federal court or state court, there's going to be a difference, perhaps, for example, if you tried a case in Florida or if you tried a case in New York, and even within a state, for example, if you try a case in Miami versus in the northern part of Florida, you may find different jurors there. So that does happen all the time. But bear in mind that jurors are instructed, and if we assume they follow the instructions of the court, they are supposed to simply put all their biases aside. They're supposed to make a decision based solely on the evidence that's presented to them during the process of the trial, and that's how they make their decision. But obviously, they bring their backgrounds, they bring common sense to it, and jurors are different. So it is quite possible that if this case had been tried in some other part of the country, there might have been a different result.
Hey, Bob, John Tucker here. Real quick, just got less than a minute left. Has Trump now violated the pretrial conditions of release in the Georgia case?
That's a good question. I don't actually know the answer to that. The fact that there's a conviction here and how that may play into his terms of release in other states, it is something that those judges may consider, but I don't think it's going to ultimately affect his conditions of release. I don't think you're going to see anything more stringent being imposed upon him based upon this conviction.
So my final question for you, why do we have to wait so long to get a sentencing here? Like, it just seems to prolong it in all the angst in the political sphere.
Well, it's really not unusual for the time between a conviction and a sentencing to be at least a couple months. In federal court, it's often even longer than that, because what happens is there is a report that's prepared by the court system. They ask all kinds of questions about the defendant, the background of the defendant, and this is an unusual case. Obviously, everybody knows who former President Trump is. They know his background, but it's going to be treated like any other case, and so it has to go through the same processes and procedures that any other defendant would, and the report has to be prepared. The defense defense has an opportunity to submit information, and this is generally how long it takes, at least a couple months before actual sentencing after the conviction.
Robert, thank you so much for joining us. Really appreciate it. Robert Mintz, he's a former federal prosecutor. He's also a partner now with McCarter and English, joining us from Princeton, New Jersey, giving some thoughts here as we await comments from former President Trump at 11 a.m. Wall Street time. Scheduled, I underline scheduled. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with a look at some of the company stories we're following. Let's start with big luxury brands rushing to make fine jewelry for men. This is David Yurman, John Hardy, Louis Vuitton, among a host of brands this year, unveiling new fine and high jewelry collections with precious metals and gemstones. Reed Krakoff is the creative chair of John Hardy, former chief artistic officer at Tiffany. He sees a larger acceptance of men experimenting with personal style. Not in this room. Indeed, a lot of football players treat stadium entrances like runway shows, and for actual high-fashion moments like the Met Gala, the Miami Dolphins wide receiver Odell Beckham Jr. and KC quarterback Patrick Mahomes wore necklaces and brooches. The men who look up to them have also noticed in the fashion world. And according to a proposed class action, Ticketmaster acted negligently in failing to protect consumers' personal identifiable information from a reported breach. Court papers say the private information of 560 million Ticketmaster customers were compromised by the hacker group Shiny Hunters on or around May 28th, and then placed for sale on dark web forums. And for the first time ever, there's going to be a beer sponsor for the Olympics.
Yeah.
But hold your horses. It's non-alcoholic beer. like, what's the point? Anheuser-Busch.
Celebratory.
Maybe in your world. Anheuser-Busch InBev has chosen to advertise to billions of sports fans a zero-alcohol product only launched in Europe just a couple of years ago. This is Corona Zero, worth $13 billion, apparently the non-alcoholic beer market. Okay.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the news in business and finance and economics through our lens of Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. We also keep you updated on world and national news. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex, Paul, John. In a few minutes, former President Donald Trump will speak in front of Trump Tower in Manhattan. Bloomberg will carry what he has to say live after Trump was convicted yesterday of all 34 counts in his hush money trial. Meanwhile, Trump's campaign says it raised $34.8 million after yesterday's verdicts. Donors contributed that sum in less than 24 hours. And Trump's former lawyer, fixer, and then prosecution star witness in the criminal trial is talking. Michael Cohen was asked if he wishes he